How important is it to stay humble in this crystal ball season, Troy?
Oh, 100%. I mean, as you guys have talked about time and time again in your show, the variance in forecasts for next year are huge. You have brilliant people calling for, runaway inflation with lower real growth. You have brilliant people calling for a normalization of inflationary pressures and a boost to real. So times like these, you have to keep your forecasts very wide and be humble and understand that there's a lot that you can't predict, not only in markets, but also in the economy.
What's the humble trade then, Troy?
Well, so from our perspective, it's really interesting as an alternative investment firm. One of the things that alternative investments have been used for primarily over the last 3 to 5 years is a fixed income substitute. And we certainly applaud that because interest rates are still low. The Fed will be hiking, and so hopefully they'll be creeping higher over time. But very hard to make money in vanilla fixed income. What's interesting now is that you're finally seeing investor appetite to use alternatives as a substitute for equities once again in order to de-risk, given the fact that the Fed will be tightening. We're at record multiples going back to the internet bubble days. And so finally we're seeing interest in people taking a little bit of money off the table as we're going into this tightening cycle with all that uncertainty and replacing in things like senior secured commercial real estate debt or CLO BB exposure through interval funds or liquid multi-strategy exposure. And lastly, we have seen more of an embrace of tactical asset allocation strategies, which is really interesting because we haven't seen that for the last several years.
Troy, I want to go back to MIT in the chemical engineering shop that you were weaned at. And there they use a phrase called reaction functions.
Yes.
Bow ties talk about economic reaction functions. You lived it. You actually lived it from where economics stole it from. Do you have confidence in the reaction functions that we see forward? Are they smooth? Are they stable? Or should we be steeled for jump conditions?
Well, look, so the number one jump condition you should be steeled for now is market reaction to a more aggressive taper and ultimate tightening. So when we think of risks that we know for next year, we know for a fact that whenever the Fed tightens, it doesn't tend to go well, and you tend to have some degree of financial condition tightening because, as we've talked about before, the Fed always gets what they want. And so if they want tighter financial conditions, they get that. And so what in turn does that mean? That arguably means we're going to have multiple corrections in the back half of the year, regardless of whether the back end of the yield curve goes higher. It's going to be a much more challenging environment to make money than it's been in quite some time. So that is we're fairly certain of.
Seen this. If you wander from Chemi at MIT over to Sloan's going to tell you, I'm sorry, corporations adapt.
Yeah.
Isn't that what we're going to see?
Yeah, well, we'll never underestimate corporate America. They've done a remarkable job, even in a very tight labor market with input costs, keeping margins high. So no one's betting against corporate America. We do see positive earnings growth next year, and this bull market could very well continue. But think about how abnormal the environment's been since the March bottom up until recently, where it's been basically a one-way trade up higher. Volatility has been relatively low. It was green light go by every asset out there, just a question of how much upside they have. And now we're entering an environment where you have to be much more careful, much more selective, and recognize that despite the resilience of corporate America, your upside's far more limited than it's been 3 months ago, 6 months ago, or a year ago.
Yeah, and what's important here, Kaylee, Doug Cass listening down at Seabreeze, and he's got a real cautious view in the market, and he agrees, Doug Cass agreeing with Troy Gajewski over the complexities were handled here at year end.
Yeah, and it's not just about the fact that we're emerging from a very abnormal environment. It's also that the fact that the Fed is going to be normalizing at the same time. And Troy, we have seen that before, where we aren't unused to a hawkish Fed. We just haven't seen it in a couple of years. How akin to 2018 do you expect 2022 to be?
Yeah, so when we draw comparisons to markets, it's always dangerous to be too simplistic. But next year reminds us much more of 2018, whereas the past 18 months was much more like the late 90s in terms of market price action and investor behavior. And if you go back to 2018, the thing to remember is that we had a strong economy that was improving in terms of trajectory or derivative, as a nod to Tom, sitting over here to my left. Sorry about that, getting your name wrong there, Tom. But
Pharaoh does it every morning.
I know, TK.
That's okay.
Can I say TK
Troy,
on live?
Yes,
No,
yes.
Easier, Troy.
Troy,
You
you're
can call him
based.
TK.
Yeah, I can call him TK. That's good.
Save yourself on this. Can I get some more Prosecco, please? Okay, thank you.
So if you look into next year, it's pretty clear that nominal GDP growth will be very strong, somewhere between 5 and 8%. The debate is whether how much will be real, how much will be nominal. So if you think of 2018, we had a very tough back end of the year, primarily because of tighter monetary policy, leading to slower money supply growth, in turn leading to fairly significant market corrections. So that's the playbook we're leaning on towards next year. It's just a question of the path.
I only remember 1 month of 2018, it was December, and basically nothing else. The rest of the year's a blur. Troy, you're welcome back anytime, buddy.
Hey,
anytime.
Good to see you, John.
You can sit in with
Good to
John
see you,
next
mate.
time because you're so based.
Good to see you, Todd. No?
Troy Gajewski there of FS, just trying to work out some of the big themes, Tom,
great.
going into next year.
Yeah, I'm sorry, John, none of it. I've got an aisle at home. I threw the library out because my eyes are so bad. John, I got an aisle of books at home. None of this is in those books.
Robert Tipp's going to weigh in on this, Tom, a little bit later over at PGIM. Just trying to work it all out, Kaylee. How much tightening we need from the Federal Reserve? Is the Fed put over because inflation is going to be close to 7 in the eyes of Wells Fargo and others? Huge conversation all about it. When it comes down to the forecast, I keep calling it crystal ball season. The average for next year, the average call, 4,800, 4,843 on the S&P.
The question is, are strategists going to be proved wrong yet again? Because that was what happened in 2021. Again, we were talking about a 2% 10-year year-end. What we're looking at on December 6th, just a few weeks until year-end, is south of 140, John.
Yep, it's a big turnaround. 4,400 the low for the forecast next year, Tom, on Morgan Stanley. 5,300 the high. So that's a 900-point spread between BMO and Morgan Stanley. Morgan Stanley at the lows, BMO at the highs.
I went into all cash 12 months ago, and the S&P's up 20%. That was brilliant.
One heck of a move this year.
you.
Up 15 on the S&P, advancing 1/3 of 1%, with Todd Key, Kaylee Lines, Jonathan Ferro. Your market up 1/3. This is Bloomberg.
Sorry.
With the First Word News, I'm Rishika Gupta. President Biden's chief medical advisor says that initial data from South Africa on the Omicron variant is encouraging. A report says that whilst the number of COVID cases surged, patients need less medical intervention. The data represent only the first 2 weeks of the Omicron wave. Still, Dr. Anthony Fauci says there doesn't look like there's a great deal of severity to the variant. In China, the central bank is trying to give a boost to a slowing economy. It's cutting the amount of cash that most banks must hold in reserve by 0.5 percentage point. That will release $188 billion of liquidity. The move puts the People's Bank of China on a different policy path than many of its peers. The UK will push the US to remove Trump-era tariffs on British steel and aluminum. UK Trade Secretary meets Tuesday with US Commerce Secretary Gina Raimondo. The tariffs are a headache for Prime Minister Boris Johnson. He said that improved trade relations with the US would be one of the major benefits of leaving the European Union. And shares of Lucid are plunging today. Pre-market, the electric vehicle maker said it has received a subpoena from the SEC suggesting its merger with a blank check company is being investigated. Lucid completed a deal with Churchill Capital Corporation 4 before its stock market debut in July. And in London, another legal defeat for Uber. The ride-hailing company lost a bid to challenge part of a landmark ruling on the working rights of its drivers. That means Uber and its London rivals will have to overhaul their business models and assume more responsibility for each trip booked on their app. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now. Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Good morning or good afternoon, traders. We're going to place an order to buy Bitcoin. If you're following my trades, if you want to trade today Bitcoin, here is your chance. Our signal, our strategy gives us a signal to trade Bitcoin right now, and the price I'm looking to buy 48,399. Okay. So order placed at 48,399. I will adjust. Stay with me, follow my trade and 399. And we will go through this trade together, and we will close this trade, of course, in profit. Okay, guys? For other people who don't have a strategy, if you're not our client yet, our customer, you can get the strategy on company.co.uk. Okay, I'll speak to you later, guys.
And the prospect of higher rates are a positive for bank stocks. Betsy Graysock seeing 3 rate hikes in their estimates, an additional 3 rate hikes in her estimates, Tom, partially offset by higher expenses, which drives up 23 EPS, a median 3%, with Wowds up 10%, the most rate sensitive.
John, as you know, Betsy Graysock is one of my favorite people on the street. She's a legit Japanese scholar, just, you know, like Robbie Feldman is from Morgan Stanley. And Betsy Graysock writes the most detailed bank reports. Every sell-side analyst is different, John. And Betsy Graysock is the numbers person. Every paragraph is loaded with facts and details about her enthusiasm on those 2 banks.
Goldman upgraded to equal weight from underweight, Tom. Wow's raised to overweight from equal weight over at Morgan Stanley.
I'm sorry, that's a tone that we see here going into the year, trying to dovetail economics into what we see on the street. And then, of course, there's the politics of the moment. With us, working on her itinerary as she moves from the Fenway Bowl in University of Virginia to the Music City Bowl in Purdue, and then finally crescendoing to the Peach Bowl in her Michigan State. Emily Wilkins will be bowled out here as well. Are the politicians going to be in session during all the bowl games?
That remains to be seen. I mean, if you're Chuck Schumer, you're hoping not. You're hoping that you're able to get your agenda done, get the debt ceiling done, get that defense bill passed, get the social welfare and tax bill taken care of, and everyone get out for Christmas. But this is Congress, Tom. Congress loves a deadline, and as we've seen in the last months, they have been blowing a number of deadlines.
So the answer is, and I think of John Boehner on this, Senator Schumer and the others, they do it alone. I mean, it's just understood that the Democrats are going to do this alone.
To a certain extent, but there is still this debate going on right now. The most recent thing that we've heard for the debt limit, can they attach it to a must-pass military authorization bill? This is the NDAA. They do it annually.
Who decides that? The parliamentarian?
It's partly the parliamentarian, but I mean, the NDAA, that's actually going to be passing normally through regular process. It's long been a bipartisan bill. Everyone wants to support the troops and the military. And so that's a potential that's being floated out there, but we've already heard from Republican leader Kevin McCarthy that that's just not his preferred way of doing things. And so it's a big question mark. If that's not the way they do it, then yes, Tom, I think you're absolutely right. Democrats really don't have a lot of options at this point except doing it via reconciliation.
We mourned the senator from Kansas, one of our great heroes. Are there any Bob Doles in the Senate right now?
I think in part that remains to be seen, right? You know, you never quite know the legacy while people are there. Certainly Republican Senator Mitch McConnell, the majority leader, I mean, he's someone who is very much respected for his ability to keep his Republican senators together. He absolutely has power now. I mean, there have been some people who have joked that he's really the one who's still seen as the majority leader in the Senate, which is, of course, a little easier to do when you have that 50-50 break there. But that's someone in particular who could be seen. But Bob Dole, he was really respected on both sides of the aisle. House Speaker Nancy Pelosi has asked that flags be flown at half-mast for former Senator Dole. And I think to a certain extent, he shows a section of a bipartisan Washington that we're just not seeing with the partisanship today.
It's a different breed of conservatism than we are seeing now, Emily. I think that's kind of the point there, that this is a different breed of Republican Party now than it was when he was in the Senate.
And I'm sure you'll hear the same thing for Democrats, saying that their party has changed. I mean, both sides in Washington, we have seen this increase in partisanship, and that's really come about through a number of things, both structural and relating to the country as a whole.
And finally, we, of course, are focused very much on the Federal Reserve here. Emily, do we have any indication that you'll get the confirmations for the second term for Jerome Powell and Lael Brainerd as vice chair by year end?
Well, at this point, we do know that the Senate is hoping to move quickly. Chairman for the Senate Budget Committee, Sherrod Brown, really does want to get these hearings underway. And we've already heard from both Democrats and Republicans that there is plenty of support for Powell, even though he might not have support from some progressive senators, including Elizabeth Warren.
Emily in town in New York City. All week, Emily?
I'll be here today and here on Thursday. Looking forward to it.
Emily Wilkins, great to have you with us here in New York. Back page of the New York Post today, Tom. Nothing to see here, just in bold, capitalized. Of course, we will have full coverage of the ugly Jets and Giants losses, but we're not going to force you to see the carnage on the back page. Do you like that, Tom? Nothing to see here. Back page of the New York Post today.
I can't provide wisdom on this other than saying this is about the ownership of the team. This is not about the air in the greater New York area.
Do you know who can provide wisdom, Tom, on college football? Katie Lyons can.
She can.
Katie Lyons, what have we got coming up?
Well, it's going to be really interesting because now you know who's going to be in the playoffs. You have Alabama, you have Michigan, which a lot of people are saying actually should have been number one, Georgia, and of course Cincinnati. The Alabama-Georgia game was painful for me to watch.
Why is that?
I just, I'm not an Alabama fan. They're so good that it stops being entertaining.
What's wrong with Bama? Because they keep winning?
Exactly.
I thought Americans loved this has been so confusing for me, Tom, coming over here. I thought Americans loved a winner. I thought they'd love Tom Brady. They hate him. I thought they'd love Bama. They don't like Bama because they win too much.
She's pulling the Cavalier wool
over
your head.
People don't like Bama. Is that true?
Half of our viewership
totally
they fell off the chair. John, this is about the northern South versus the southern South.
Is that what it's about?
Yeah.
Okay.
There's the.
I've got to understand the nuance of all of this, Tom.
And you go down. I'm sorry. It's like UVA versus.
Can we agree on one thing? That quarterback for Alabama, Bryce Young.
Yeah.
Katie Lyons, he is unreal.
A lot of people saying he's going to win the Heisman this year. It'll be interesting to see. He's only a sophomore.
Kaylee, are you going to Fenway Park to see the inaugural Fenway Bowl?
Yeah, no, I'll leave that one to you, Tom.
Oh, come on. UVA's playing SMU.
Yeah,
to me, it's sacrilege, but what do I know?
UVA football is not as exciting as Alabama or Georgia or Michigan football. Let's put it that way.
I've got into it this year. Just say it. Futures up 13 on the S&P, up about a quarter
Emily
of 1%.
Wilkins
Call it a
is,
third.
Emily Wilkins is
She
here
really
going,
wants to
"What
weigh
are
in on
they
this
talking
stuff. Yields up 5 basis points to 139.
We're all a bunch of amateurs
52. I
compared
mean,
to
I'm a
Emily.
total tourist, Tom.
Look, I agree with Kaylee on Alabama.
There we go.
What
Thank
is
you,
the
Emily.
anti-Alabama stuff about? Anyway, whatever. Can we talk about West Ham Chelsea, Tom? Do you want to sit on that for a moment?
Please.
Wasn't that fantastic?
It was.
West Ham
You
just
know,
putting it out of the
and
bag this year. I think it's great.
They don't have, John, seriously, they don't have the budget that the other big teams do.
They certainly don't have the budget of Chelsea,
Yeah,
which was the
okay.
team they beat over the weekend. That was West London with all the money, Tom,
Right.
and East London with much less
Yeah.
money, and East London getting it done over the weekend.
The Tots crushed. Is it Norwich or Norwich? How
It's
do you
Norwich.
say that?
It's Norwich.
Norwich.
This was your
Where's the
alternative
W
sports
go?
segment on Bloomberg TV and radio. Coming up, Jane Foley
Monday,
of
more
Rabobank
Prosecco.
with its equity market
That was
up
based,
11,
John. You were based.
up a quarter of 1%. I tried, Tom. I tried. From New York City, this is Bloomberg.
An extra $1 trillion in spending, not increase inflation.
By increasing the productive capacity of this country. And that's a very important thing that we frankly have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became transportation secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that part 2 of the president's agenda, what I like to call the big deal, but part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
Some good news for you if you are sick of the Fed speak. It's the blackout period, the quiet period. They go quiet for a whole week into a Fed decision next week on December 15th. Going into this morning, as we kick off a new trading week, futures up 0.2% on the S&P. Off the lows of this morning, as we took a little bit of a dip into negative territory about an hour or so ago. On the Nasdaq 100, futures there negative about 0.5%. On the Russell of small caps, up 0.8%. Big conversation about the bond market. Whippy, volatile, up, down, up, down, up, down. Yields lower Friday, 10 basis points. Higher this morning by 5 basis points. The distance between 2s and 10s. We ended last year at about 79 basis points. We topped out this year at 157 at the very end of the first quarter of this year, from 157 all the way back down to a 74 handle in Friday's session. Tom, it's been a round trip. That distance between 2s and 10s getting narrower. That curve, Tom, getting flatter.
And the different curves are here. Abramowitz is not here today. She'd be all over the 5s 30, the 2s 30, and the rest of it, John. I don't know which curve matters, but what they tell me is all the strategists got it wrong.
Take your pick, Tom. Pick your house. It's been difficult to call. And speaking of house, Sarah House of Wells Fargo, what was it, Tom, an hour ago? Looking at 7%. On average, inflation 7% through Q1 and 6.9% this Friday.
This statistic this Friday as well, I don't think the street's prepared for 6.9%. I mean,
we've got to figure it out. 6.7 is the median estimate. So switch at the board and finish on the curve, just to give you an idea of the shape of things through the year. Tom, steeper, 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 and then we just flattened out to close out the year. And we need to have a conversation now about how much work the Federal Reserve needs to do to even tighten monetary policy, given how deeply negative real rates are, Tom. And how much appetite they'll have to do that, with the curve already looking like this going into next year.
No, the markets adapt and adjust. That's all there is to it. You know, in this case, it's clear the markets are out front of the visible Fed rhetoric, or seriously what we're going to see in a number of days, the 15th.
Was that based?
Yeah,
just working it out as we go along, kids.
You know, it's all based.
It's all based, whatever that means. That's your cross-asset price action this morning. Let's get you some individual names, some stock movers. We can say good morning to Romain. Good morning, Romain.
Good morning, Tom. Good morning, John. And Kelly, we talk about the Chinese stocks. They're back in focus here on this day. Didi down about 7% right now. All of these stocks fell pretty hard in Hong Kong trading. Of course, we know Didi started that process for delisting from the United States last week here. A lot of concerns about the U.S. pressures, the U.S. regulatory pressures on some of these U.S.-listed Chinese names. The pressures, of course, out of China, and now some concerns here about a potential slowdown, or a greater than anticipated slowdown in the Chinese economy. Alibaba had been down as much as 6% in Hong Kong trading. The ADRs were also down here. They're getting a little bit of a rebound. This after announcing that they'll have a new CEO, Tony Zhu, going to take over from Maggie Wu starting April 1st. They also announced some other leadership changes, and that's why you're seeing a little bit of a green here, up about 0.8% here, but pretty much across the board, all the Chinese ADRs in the red here in the pre-market. Also keep an eye on Bitcoin, the ProShares Bitcoin ETF. That's the new one that just launched last month, down 9% here in the pre-market after that stunning plunge by pretty much all the crypto assets over the weekend. Bitcoin, Ether, Litecoin, all those shares tied to the crypto sphere right now, lower here in the pre-market. All right, flip up the board here. Let's talk about another high-flying sector. Of course, that was the EV sector. We learned over the weekend that Lucid Group actually got a subpoena from the SEC on Friday. This apparently has to do with the structure of their SPAC deal. Remember, they went public through Michael Klein's Churchill Capital. There's been a lot of scrutiny by U.S. regulators over the financial structure over some of these deals. These shares down 14%. A lot of the other EV companies that also went public via SPAC, like Fisker, Canoo, and a few others, also lower here in the pre-market, down 3%. Rivian, which actually went public through a traditional IPO process, getting dragged down in this as well, down about 2.5%.
Romain, of those three companies, and on radio, he's got them lined up there. Have any of them sold any cars that are electric?
Well, Rivian sold about 50. I think Fisker is in the hundreds, and Lucid Group is also in the hundreds. So you're still talking about a pretty nascent companies with regards to their deliveries. Yeah.
Romain Bosick, thank you so much. And nascent, and he'll be on the close this afternoon with the debris from the market day. This is a joy because Jane Foley has a more measured view of the guesstimates of foreign exchange, being at Rabobank with their huge global commercial interests. We're thrilled she could join us right now. Jane, I went back 12 months and looked at the call, this off Reuters, of everyone predicting a weak dollar. They got it wrong last year. They got it wrong the year before. There's been this perma weak dollar call forever. Does it sustain this year with another consensus weak dollar view?
You know, I don't think so. I think the market really has come round to the fact that the dollar is performing really quite well. Now, there's one metric here I think that the market really does have to pay attention to, and that's the relationship between the dollar and the inverse relationship, I should say, with emerging markets. And you have this scenario now where, of course, the dollar is pretty strong. That just places additional pressure on emerging market economies. And until you are more confident, perhaps, that EM can rally, that money's going to pour back into EM, it's very difficult to imagine that the dollar's going to weaken. So I think for now, the dollar's going to stay strong. And really, I think we've got to wait some time before we get a little bit more hawkish on the ECB, et cetera, and other central banks before we begin to think about the dollar, losing significant ground.
You mentioned money flowing to EM. As your study of foreign exchange now, your guesstimate of the major pairs, is it a flow analysis or a rate analysis?
Oh, well, you know what? It's both. I don't think you can pull the two away, because as the perceptions of Fed interest rates for 2022 became more forward-thinking, then obviously the dollar went up, and that, of course, attracted flow out of EM and back into the US. And I think that's a scenario we're still really in the thick of it now. But one thing that does worry me, though, is that there's a lot of long dollar positions on. And, particularly, I think a month or so ago, we saw this big movements towards the dollar. And I do think that over the last few weeks, we've seen some of those positioning being taken out. But I think we might have further to go. So although I think in essence the dollar can go further, that it has got further to go, I'm happy that we're seeing a more consolidative phase, that we've seen some of those long positions kicked out. And I think we've got more of that type of activity in the weeks ahead before we can perhaps move on to a little bit more additional dollar strength.
Jane, quiet period for the Federal Reserve this week. The Bank of England, though, policymakers are talking. Ben Broadbent, one of them, the Deputy Governor over at the Bank of England, refusing to say, won't decide on rates until the next meeting. The meeting, of course, is next week. Thursday, after the Wednesday Fed decision. Cable right now, sterling 132.73, positive a 0.25%. Jane, why make it easy? Let's focus on sterling and work out what on earth to do with this one going into next week.
Well, I think they did have a communication problem going into the November policy meeting. It did appear that they had signalled, or particularly that the governor had signalled to the market last month that they would hike, and of course they didn't. And I think now they're just being a little bit more cautious. They just don't want to lead the market up the garden path. But Ben Broadbent did say something which I think was particularly interesting this morning. And again, he spoke about the labour market, that if we have more tightness in the labour market, then that could have implications for inflation, make inflation a little bit more persistent. And I think, I would agree with him. I think often a lot of the answers when it comes to inflation are in the labour market. And just like the US, where there is a tight labour market, which does bring the likelihood that we're going to get second-order price effects through wage inflation coming through, well, the UK perhaps is behind the US in terms of the lineup for the G10 economies. There is the possibility that we might see some second-order inflation effects in the labour market here too, and I think that's something that we need to watch in the UK.
There is a possibility, Jane, that by the end of next week we'll have gotten a hike out of the BOE, we'll have gotten an announcement from the Fed that they're accelerating the pace of the tapering, and an ECB that is looking more and more lonely in a tightening world. What does that mean for the euro?
Well, I think we've seen this for some time now, really playing through, and the euro, of course, is on the back foot because of this. Now, I think perhaps it's a bit too early to assume that we will get that hike next week from the Bank of England, but it could come in February. But we know, the ECB is nowhere close. It really is, on the bottom of the line. But it's not the only G10 central bank that is still dovish. The Australians, for instance, they've got a meeting this week. They are likely to remain pretty dovish as well. But the ECB, the Bank of Japan, they are the two that are most dovish, and that does mean, certainly for the euro, that it will be on the back foot, probably for some months.
Jane, just quickly, what's the call for next year you're most comfortable with? Highest conviction call going into 22?
I think it's still some dollar strength, certainly for the first 6 months of the year. Maybe towards the end of the year we get a little bit more catch-up from some of those other G10 currencies, but I still like the dollar.
Jane Foley there of Rabobank, looking ahead to 2022 and beyond. We've got to get ahead to next week. A Federal Reserve that decides on a Wednesday, the Bank of England, the ECB on the Thursday. President Lagarde, Tom, now calling it a hump. It's not transitory, it's a hump. It's going to look like a hump through next year.
Oh, come on, they're just, you
Just
know,
describing the
it's
inflation chart
It's like
into
playing
next
with
year.
shadow puppets. I mean, everybody's making it up as they go. John, I'm going to go back to what you're focused on, which is 6.9% inflation off of the Wells Fargo desk. And frankly, dovetail that with what we learned from Betsy Graysock at Morgan Stanley this morning, her enthusiasm on the banks. John, as you know, the surveillance team, we're deep in research. With that team of interns we have, they really can drive forward our knowledge. Princeton Review, here's the difference, folks. We've had a huge response to this after Kayleigh Lyon's completely inappropriate comments, absolutely tone deaf. University of Alabama is listed last year as the #1 party school by Princeton Review. John, UVA isn't even on the list.
They don't make the list.
They don't even make the
How
list.
long's the list, Tom?
I mean, Liz Ann Saunders, you'd expect it. University of Delaware is #2.
What are the metrics for the #1 party school? How does that work?
Kayleigh, please, you know.
How can you dislike that school? #1 party school, fantastic football team. You basically win every week.
All that valid.
What's to complain about, Kayleigh?
I'm not saying anything against the University of Alabama.
It's just the football team.
We're being specific here.
Because they win so much.
Exactly.
Okay.
I'm not a poor sport or anything.
Doesn't sound like it at all.
Bucknell is the #8 party school in the country.
Bucknell
is
#8.
I never would have guessed that.
That is a school in Pennsylvania for people trying to follow
That
at home.
explains a lot about
outside
Chanel
of
Bassett,
America.
frankly.
Did she go to
That
Bucknell?
explains a lot about
I did not know that.
Yeah.
For the record, Tom, I had plenty of fun in college.
I thought that was a very expensive private
I didn't
school.
have any fun in college.
I thought Bucknell was a very expensive private school. And it's
It
also a party school, so you pay a load of money to
Exactly.
go. College in America is a confusing one, isn't it?
Dr. and Mrs. Bassett, it is.
Up 14 on the S&P, advancing a third of 1%.
I had no fun in college.
From New York City.
Zero.
This is Bloomberg.
With the First Red News, I'm Rishika Gupta. A new report from South Africa says that so far the Omicron variant hasn't led to a surge in hospitalizations. South Africa is the epicenter of the outbreak of the new strain. President Biden's chief medical advisor, Anthony Fauci, says that whilst it is early, it doesn't look like there's a great degree of severity caused by Omicron. The U.S. reportedly will declare a diplomatic boycott of the Beijing Winter Olympics. According to CNN, the decision not to send any U.S. officials to the Games in February will be announced this week. The move would be largely symbolic. Few U.S. officials are likely to visit China anyway due to strict quarantine rules and clashes over human rights. Saudi Arabia is signaling that it sees demand for oil staying strong despite the spread of the Omicron variant. The Saudis have raised prices for buyers in the U.S. and Asia. The move comes days after OPEC and its allies surprised traders with a decision to boost oil output. And President Biden praised Bob Dole as an American statesman like few in the country's history. The longtime Republican senator from Kansas and 1996 presidential candidate died yesterday. He was noted for being a political deal maker and pushing legislation for Americans with disabilities. He was 98. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Rishika Gupta. This is Bloomberg.
talking about Bloomberg surveillance.
There's some guy out on Twitter who says, I look like I'm 101.
I know, I noticed that.
Do you think I need a lift? Is it time
What
that
did
I...
he say about me? What did that particular gentleman say about... Let's have a look. One of them is near 101 years of age.
Which one would that be?
Okay, guys, I'm placing an order to buy euro.
Who's that?
112,
The only chance to
97.4.
conversation. It's a fairly accurate summary of this show, isn't it, Tom?
Okay, order placed 97.4 to buy euro. Okay, if you're looking to buy, to trade euro against United States dollar, here is your chance to buy.
Also, we have been preparing.
We're still holding order, many orders to buy right now, so we're still in. I'm looking right now at the screen.
Will work. So
and it didn't fill yet.
Understand more about this virus. The second, of course, will be to protect.
Okay, guys.
And the third is to treat. Let's take it one after the other to understand.
Sorry, we didn't fill yet. All of you guys who filled the order, well done. For us, we still order in process of filling this order. It's not surprise because we're trading very large amount of money and not many
clinical cases.
Private investors or even institutional investors can afford to execute this order. Okay, you can fill this order. So we're waiting slowly until this order will be filled. Okay, guys. I'll let you know when we're going to fill this order. I'll speak to you later, guys.
Messages from heaven from him saying you're doing a good job protecting my name?
I haven't, but I did meet his son Baron. He was quite proud of what we had done with the company and suggested to me Conrad would have been as well.
Hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
From New York City.
Here in London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
The Fed has tried to create an inflation cycle for 10 years. Who's to say they're going to be able to keep it under control? This is an environment where I don't know if the Fed's going to be able to quell market volatility.
Savita Subramaniam of Bank of America on fire going into the weekend last week. From New York City this morning, good morning. Tom Keene, Jonathan Ferro and Katie Lyons. Lisa back with us tomorrow. Your equity market trying to bounce off the back of a week of losses on the S&P, up 14, advancing a third of 1%. Yields are higher after moving lower in Friday's session, down 10 Friday, up 4 this morning, 138.68. In the FX market, muted price action, euro dollar, a move lower, negative of a little more than 1/10 of 1% to 112.99. Tom, the correction lower of the all-time highs, something like 3 or 4 percentage points from the S&P. It has felt so much more difficult than that, though, Tom, over the last couple of weeks.
Well, it is. This is really important what John brings up, folks. There hasn't been a correction, but if you take out the high-flying stocks that have done so well over the last 12 and even 18 months, there's a lot of this market that feels like a correction. Kriti Gupta's looked at this. Her chart of the day has to do with our non-correction correction. I'm confused, Kriti. What do you have?
Well, we don't have a correction, and that's actually the staple of 2021. Essentially, you have these very shallow pullbacks, 4 or 5% moves. And then the last 9 sessions since that Black Friday sell-off, about a 4% drop, 5% if you're counting intraday. And that's what my chart really tackles here, this idea that if you start to see these pullbacks, how long does it take to really buy those dips? And turns out in 2021, you've had about 5 of those pullbacks, about 5% each, and it's taken about half the time to recover those gains. That is not normal going back into history. And the last time we saw that was actually in 2016, the start of 2 solid years of global growth.
Are you able to look at this chart and take out the 10 or 12 high-flying stocks?
I could do it.
Is that feasible?
I'm sure it is feasible.
That would be really interesting, don't you think?
I think so.
To John's point, away from Apple, Amazon, Google, Microsoft, and the rest, it's really been a rougher year, hasn't it?
It has. And to your point, when you do start to see those recoveries that take about, like I said, half the time from those sell-offs, they're almost always driven by big tech.
Let's do another chart. Kriti Gupta, thank you so much. Greatly appreciate that this morning. Ani, I'm going to avoid Turkey right now. We'll get to Turkey on Tuesday. Damien Sassower joins us here. Ani, Damien, on China, I looked at the Evergrande 25-year. Thanks, Joe Weisenthal, for bringing that to my attention. It cratered this morning. What is the symbolism of China's debt going south?
Well, you know, I mean, look, the fact of the matter is, even your friends at Bloomberg Intelligence get it right every so often, Tom. And so for us, it's about this triple R cut of 50 bips designed to assist small and medium enterprises in China. And so basically, yeah, the Evergrande issue, 82.5 million of coupon payments are basically coming due this week. The 260 million in the Scenery Journey bonds, yes, again, you know, the grace period ending. What's interesting also, if you have Kaisa's basically been trying to restructure its debt, and the bondholders couldn't come to an agreement. Lazard is running those credit committees, and they're probably going to default this week on another, call it 85 million odds. So, you know, a lot to handle, a lot to stomach. But yes, your friends at BI got it right. The 50 bip triple R cut, much flagged, and here we are today, looking for another 50 to 100 bips next year.
But does it make a material difference when you're faced with a property sector this much in crisis?
It does, yeah. No, I mean, look, Kaylee, I mean, we've been looking for any sort of assistance for the property sector. I mean, you've got $10.4 billion in China defaults, offshore bonds this year. That's a record. 36% of that is the property sector, Kaylee. So, yeah, you know, we need, I mean, the property sector in China needs all the help it can get, but it is getting it. I mean, look, China is relaxing mortgage credit standards onshore. And so hopefully, you know, after we get into the real formal restructuring for Kaisa and Evergrande, things are going to turn for the better.
Does that mean you don't need any further easing from the PBOC beyond just cutting triple R?
No, I think we're going to need to see another 50 to 100 bips next year for sure. Just given, you know, the medium-term lending facility, you know, the bonds that are rolling off, the long-term capital situation at the banks. So, yeah, you know, we're calling for more cuts in 2022. But look, China, and outside of Turkey, China is the only central bank in the world heading in that direction, cutting rates in the face of higher inflation. And we get inflation data later this week.
Damien, to grizzled pros like...
Okay, guys, position opened on Euro, 112, 97.4. Okay, I will adjust, 97.4. Position opened, well done, guys. All of you who decided to trade Euro, stay with me and I will guide you through. We'll go through this trade together. You have a chance because it moved lower. But don't forget, we hedge positions as well. If it will move substantially lower, we will do other tricks in order to get winning trade on Euro. So if you don't know how to do this, you better get the strategy. Otherwise, you might stuck for quite a long time with your position. Stay safe, guys.
Below 110 in the first half next year, but a move to 105 or below probably needs a significant rally in dollar China, which is a risk rather than a likely event in 22. That's the mystery of foreign exchange for me this year, Damien. That strength in the Chinese currency. Damien, what underpins that going into next year?
Oh, Jonathan, what a great question. I mean, look, here's where we are right here. Dollar yuan is trading relative to CFET's basket, which is how the yuan performs relative to, you know, its largest trading partners. Is trading, it's trading at the same levels we saw when we had the big devaluation of the yuan in 2015. That is a risk. I think that's probably what Kit is flagging here today. And I don't disagree with him. You know, I mean, yuan has basically rallied, I think, 2.8% year to date. I mean, China local government bonds are up 8% year to date. Find me another fixed income asset class, Jonathan, where you can find an 8% total return in dollars. You're not going to find it anywhere. So, you know, yes, a lot of it is driven by dollar yuan strength. Whether we've gone too far remains to be seen.
What a fascinating time. 637.82 on dollar China this morning. Damien, thank you, sir. Damien Sasser there of Bloomberg Intelligence on emerging markets. Tom, this currency, it's the mystery of foreign exchange for me. If you told me we would get a 6-7 percentage point move on the dollar index and then said, where's the Chinese currency in that? How many people would have said stronger on the year against the US dollar?
Everyone would have said it, and you're right, it's a mystery, and my answer is it's manipulated. It's not a fixed currency, John, but I would suggest there's heavy manipulation in there. What I really am upset about, John, is, you know, I look at the What a Great Question score today, and you're killing me and Kaylee. I mean, you know, I'm like not even there.
Where's Bramo, Tom? Lisa just crushing it, though.
Yeah, she is.
Lisa can take the day off and then look at the tally at the end of the week, Tom, and she's still winning.
It's true. It's true. But, I mean, you get what a great question from Damien. I never get that. The question for me, John, at foreign exchange is you get a 105 euro. Who's prepared for that?
Oh, yeah. I mean, 110's just around the corner. 110's just around the corner from where we are right now, 112.99. That's not a massive call. Maybe we get there, maybe we don't. 105. Kelly, 105. What would we need to see to get down to 105?
Well, I wonder if next week is going to start to answer that question, John. If you get more moves toward tightening for the Fed and the BOE and the ECB stays dovish, what does that then, pray tell, indicate for 2022 and whether or not we're going to see persistent euro weakness?
The countdown to next week continues on this program. We'll do that with Robert Tipp, Chief Investment Strategist at PGIM Fixed Income. That conversation just around the corner. Go on, TK.
Aston won. The new guy.
Aston Villa.
Nice win, yeah.
Steve Gerrard.
Yeah.
Were you happy with that? Are you supporting Aston Villa now?
No, I'm not.
It's Mervyn King's
I'm just
club.
trying to, I'm trying to bond with you, John.
Okay, just going to shout out random,
You're so
random
based.
football teams.
I'm just trying to,
Aston Villa.
hang out with someone as base as you.
Aston Villa. 138.17 on 10.
Aston Martin.
Yields up 4 basis points from New York City on radio, on TV. This is Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you You can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You've had a spectacular level of support for asset inflation across all markets.
The bubble right now is not in stocks, it's in bonds.
The messaging from the curve is very, very pessimistic.
At some point, valuation will matter again.
I don't think this is the time to chase steep value.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene on a Monday. A full and eventful week ahead for us on radio, on television. We say good morning, John Farrow. Lots of different news flow here. China, maybe 2-3 hours ago. And what I'm seeing right now is, it is a look to the inflation report of Friday.
This Friday, CPI 6.7%, your median estimate 6.9%, the call that came from Wells Fargo hours ago on this program. The biggest risk question I've got, Tom, going forward through to year end, are we facing a repeat of 2018, the prospect of choking on the prospect of higher rates at the Federal Reserve?
We're going to get to that with an important guest here in a moment. If you're part of Global Wall Street, please stay tuned for Robert Tipp. On the compare and contrast of 2018, John, history never repeats itself, and the overwhelming reality now is the fiscal deficit and, frankly, what Washington may do.
There are some really key differences, Tom. The difference between then and now, 2% on inflation then, close to 7% now. Then and now, Tom, the Federal Reserve is already hiking. They've still got QE running north of 100 billion, and they've got to wind it down, and maybe they accelerate that. There are some key differences, Tom. Remains to be seen, but the call from PGIM over the last few months, they think the highs on 10-year yields are behind us, not in front of us, and this morning we're south of 140.
The sharp differences we see on Wall Street, Kaylee Lines, what's so important here is to dovetail it into the global view. Jane Foley making really clear, China, we have to watch every step.
Also making it clear that the strong dollar story is not over, Tom, and that, of course, was a not consensus view coming into 2021, but there's a lot of calls the strategists got wrong, and yields are one of those as well.
John, let's review this quickly. I know with Robert Tipp we're going to do the yield story, but John, what I saw were two stories out of China. One was an accommodative bank due to a real estate crisis, and the second was a reaffirmation of the real estate crisis seen in price down for Evergrande paper.
The classic policy out of China, isn't it, Tom? They tap the brakes, cause some problems, and then push the accelerator again. When they cut RRR, the reserve requirement ratio, I've always seen that, Tom, as boosting the supply of credit, not necessarily dropping the price of credit. That seems to be what they're doing, just to alleviate some of the pain, just to support the real estate market, just a little bit, Tom, as we work out some big issues.
On debt, the 10-year yield, 1.39%. John, I am stunned that we've moved from a 174, and that trend has already begun to lower yield.
Go through the data. CPI close to 7, the ISM at 69, a labour market report beyond the headline number that seemed to be pretty decent, a Federal Reserve set to respond to that, and a 10-year yield at 139. Robert Tipp's going to explain it in a moment, Tom, but for a lot of people, they've been quite confused by it.
Yeah, the data check today, I mean, it's a jumble here. John, what sticks out to you? To me, it's the VIX coming from a 31 into 30, and the VIX right now 29.80. I'm not going to call it a great tape, a constructive tape.
A better tape than where we were a couple of hours ago. We're positive at least on the S&P 500 by a third of 1%, on the NASDAQ 100 down 58, negative 0.4%. What jumps out to me, TK, bonds all over the place, down 10 basis points Friday, up 4.5 this morning to 138.85.
The real yield on negative 1.10 comes in a little lesser negative 1.09. He rides the team at PGIM. PGIM has had a terrific run here in the fixed income market because they have been supple. They've been able to move, and it's given them a really, really interesting track record. Robert Tipp joins us this morning. Robert Tipp, the basic idea I'm hearing is yields have hit the high, yield down, price up. How opportunistic is the first 6 months of 2022? Is it like the one or two other times we've seen since the great financial crisis where you can make total return in bonds?
Well, I think that it is. I think it's a matter of what the relative benchmark is.
we've passed the peak in long-term yields, and we're probably passing the peak in the front end for yields now. And the return on the bond market is likely to exceed cash. We're likely to stay range-bound, kind of centered around where we are right now. And so I think traders are going to have to be very skilled at trading that range. Investors are going to have a much easier time. That's the lesson from the past tapers. That's the lesson from the earlier analogs in history that are like this environment we're in right now.
Rob, you made two calls there. At the long end, I've heard that call from you before. It was months ago, and it's turned out to be right going into year end. Do you think the highs on a 10-year are behind us right now? We're well south of where we were at the highs of the year in Q1, pushing 180 at south of 140. You just said that maybe the peak at the front end might be behind us as well. Robert, why?
Right. Yeah, I think so. For yields out to like your 3-year point for now, I mean, once you get 12 months down the road, if it turns out, you know, we're in that part of the probability spectrum of very strong economy, inflation staying high, Fed is really hiking rates 3 times next year, you're going to have a stair step higher in the front end. But for now, you're at that point where the Fed has really shot all their bullets. They announced taper in November. Within a month, basically an intermeeting move, right, to accelerate the taper, which is really raises some questions. And the market has moved on a one-year basis in OIS. So on average, where will the funds rate be on average over the year, you know, from 0.1 years out to the point 1 year to 2 years out, over 1%. That's a lot of rate hikes to price in there. So now the market has to sit and wait. And I think it's unlikely they're going to push those bets further on the front end of the curve.
Rob, I think this is such a fascinating moment because the likes of Deutsche Bank are asking a question over the weekend, last week into this week, how much work they need to do. Maybe they need to go even higher to tighten in an economy like this one. And you're saying they've shot all their bullets already. They haven't even really done anything yet. Robert, can you reconcile what that debate sounds like from your perspective?
Right. I mean, could be wrong on this, but you know, from our perspective, the way this goes is by the time they have the information set to project the rate hikes that the Fed is projecting, to have the nerve to do the taper, look at where we were at the end of 2013, December, when they announced the taper to begin in January 2014, you were at 3%. By the time the Fed got around to hiking interest rates at the end of 2015, you were at 2.2% on the 10-year. You had a big rally. By the time, just before they were ready to really, you know, get into the mode of hikes in 2016, you were in the low ones. So you're in a very dangerous period where the Fed is going to be in a wait time. They've accelerated the taper against a backdrop of going into flu season, of a new variant hitting, of oil prices falling, you know, so, you know, I mean, they did get one higher inflation number, but you also got...
So, Rob, let me put you on the spot, because I think this is so critical. Do you see the risk of a December 18 repeat? We're just talking about it this time around. They then have to back away from getting anywhere close to what people are talking about.
I think that Powell was on the right track of trying to keep the markets away from that. He was trying to focus on the here and now. And now they've lost that narrative a little bit. And we've seen 2 weeks of stocks falling and yields falling. So I'm assuming that there's been a learning curve and that he's going to see that and he's going to corral the committee and say, you know, if we want to have the flexibility to raise rates next year, if we think that's appropriate, we have to keep the markets on track that we are pro-growth with stable inflation and that we're not going to have an imbalanced reaction, as opposed to last time, which was, you know, we have a long way to go to neutral, which freaked the market out.
How do you think the Fed is factoring in the fiscal equation? Obviously, we don't know what the final form of the Build Back Better plan will actually look like, if it'll even get passed early next year. But if it does, and there's an inflationary aspect to that, does that force the Fed's hand to some extent?
Well, I think actually the fiscal is another factor that I would have put on the economically negative sides, right? It's not that we are having a little bit of stimulus kick in, presumably in the years ahead based on these programs that are passing now. The amount the government will be spending through these programs is so much less than what we had in years past that effectively growth has been inflated over the last couple of years by a couple of things. One is the fiscal, and then a related item of that, which was a spending down of the high savings rate that generated. So I think it's great. I think in terms of growth, that should cushion the deceleration in growth that you'd otherwise get. But it's not a big step up on the fiscal side. It's a step down.
Robert Tipp, that was a clinic. Send our best to Greg and Mike, won't you? Robert Tipp over at PGIM. Thank you, sir. Thank you very much. Tom, a clinic on a very different view on this bond market and the path forward for this Federal Reserve.
It's a different view shared by, in the economic front, David Blanchflower at Dartmouth and David Rosenberg up in Toronto. John, it really partitions out the call. And again, we'll see how this plays out. I mean, it's wonderful. It's what keeps us going.
Well, on tens, he's been right. From the middle of this year, when he turned around to me months and months ago and said the highs are in, we've been lower since. We're at 138 on tens. But to say that at the front end of the curve as well, Kayleigh is scratching my head then, but I feel the same way I felt when he said this about 10 6 months ago, and he's saying that maybe we've peaked at the front end too.
Yeah, and maybe he'll be proven to be right that the bulk of the flattening is also over, that a lot of this has already happened in 2021. The question is, what does 2022 then look like if you are faced with a normalization of policy more quickly than we previously anticipated?
But what's normal? That word, we keep picking up on it, don't we? TK, what's normal? What's normalization in the world of nominal growth where it is, where inflation is close to 7 and rates are still rock bottom?
I think for everybody just tuning in on radio and TV, here is the conundrum of this Monday. How does America do 9% nominal GDP? John, no one has a clue.
Equities up 16 on the S&P, advancing 1/3 of 1%. On policy down in Washington, Greg Valliere of AGF Investments. That conversation just around the corner. From New York City for our audience worldwide, heard on radio, seen on TV, this is Bloomberg.
With the First Word News, I'm Ritika Gupta. In China, the central bank is trying to give a boost to a slowing economy. It's cutting the amount of cash that most banks must hold in reserve by 1/2 percentage point. That will release $188 billion of liquidity. The move puts the People's Bank of China on a different policy path than many of its peers. President Biden's chief medical advisor says that initial data from South Africa on the Omicron variant is encouraging. A report says that whilst the number of COVID cases surged, patients need less medical intervention. The data represent only the first 2 weeks of the Omicron wave. Still, Dr. Anthony Fauci says there doesn't look like there's a great deal of severity to the variant. The UK will push the US to remove Trump-era tariffs on British steel and aluminum. The UK Trade Secretary meets Tuesday with US Commerce Secretary Gina Raimondo. The tariffs are a headache for Prime Minister Boris Johnson. He said that improved trade relations with the US would be one of the major benefits of leaving the European Union. And shares of Lucid are plunging today. The electric vehicle maker said it has received a subpoena from the SEC suggesting its merger with a blank check company is being investigated. Lucid completed a deal with Churchill Capital Corporation before its stock market debut in July. Francis Saint-Gobain is betting that President Biden's infrastructure plan will lead to a building boom. The building materials maker has agreed to buy U.S. construction chemicals company GCP Applied Technologies. The price, $2.3 billion. That represents an 18% premium over Friday's close. Global News 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Ritika Gupta. This is Bloomberg.
the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Up front, when your shares are down 20%, it's got to hurt. But talk to us about, well, really what you're seeing. Take us more forward-looking. Are you worried about people exiting pandemic era and going back to the gym, or are we going to work out at home more?
Well, that's actually the advantage that Beachbody has is we have never been a direct competitor with the gym. In fact, what we rely on is our ability to influence the 150 million people in North America specifically who are overweight or obese and haven't made that choice yet. Our job is to influence them with great content and this combination of what we call the total solution: fitness, nutrition, and community, so that they can tap into this incredibly cost-effective solution that is entertaining and engaging right at home so that they get results. That's our job, is to help the new person engage in healthy lifestyles.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation, and we believe that the Q3 was the quarter that was most affected.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
The October CPI was a wake-up call that this inflation environment is going to be somewhat longer lasting than they anticipated. And I think more importantly than just the duration, it's the magnitude. So we're looking at 7% CPI come Q1. And so I think we have seen the Fed realize that in order for inflation expectations to remain close to 2%, that they do have to make adjustments. And I think we'll see that very soon.
Sarah House of Wells Fargo setting us up for 7% CPI in America. Q1 next year. She's looking for 6.9 this Friday. Wow. Your estimate nudges up to 6.8. We are days away from that inflation report in America. From New York City this morning, good morning. Alongside Tom Keene, I'm Jonathan Ferro. Together with Katie Lyons, your equity market. Equity futures up 18, advancing 0.4%. Yields higher by 4 or 5 basis points on 10s to 139. Bit of news out of New York City. Katie, what do you got?
Well, Mayor Bill de Blasio is speaking on MSNBC talking about the vaccination requirements, saying that it is now required for kids ages 5 to 11 to be vaccinated to enter restaurants. He also is saying that they will impose a mandate for private sector workers starting on December 27th. Of course, we knew already the mandates that were in place for public sector, but now that will be extended to the private sector in just a matter of weeks, John.
Dear me, TK, to go out in New York City, that's it now. You either go and get a vaccination or you cannot engage in society in the way you used to.
I started the day, John, looking at what they're doing in Europe. I mean, how close is Europe going to get to what we saw from Germany in the last 10 days? This is a movable feast right now.
I have to say, New York City, Tom, is probably already there. It's pretty close to what we're seeing take place in Europe. You have to show up at the restaurant. Did it over the weekend. You've done it. Kelly's done it. We've all done it. You show up, show your vaccine pass, then you have to show photo ID as well. Yeah. You've got to show both.
Yeah, we had the photo ID thing this weekend. That was a bit of a surprise. Right now, and we want to dive into the politics of Washington as we can, but we must take a moment with Gregory Valliere. He is chief U.S. policy strategist at AGF Investments, but far more in his he had the ability to buttress up against names like John McCain, Alan Simpson of Wyoming, who I found just always entertaining and incredibly shrewd, and a senator from Kansas as well. Greg Valliere, Bob Dole, and it was as simple as you mentioned in your note, you were confronted with his realities with a shake of the left hand. He was different.
He certainly was, and he was in pain, Tom, every day of his life after his injury, and he never once complained about it. A true giant in the Senate, knew how to get things done. I'd say a giant in the Senate compared to the pygmies we have now in Congress. This was a very impressive guy, and he was sarcastic, he was sardonic. Sometimes his humor cut a little too much, but you know, we didn't walk in his shoes. He suffered a horrific injury and never really fully recovered.
Senator Schumer has to provide leadership here. In the House, there seems a given that the Democrats will give way to the GOP. Does that work for Schumer right now as well? Is he assuming a Republican Senate in November of next year?
Well, he has to assume a Republican House. I think that's a given, Tom, and the Senate is certainly possible. So they need to get everything they can in the next month or two. I think things will get pushed into January. I don't think they can get a debt ceiling done fast enough. We'll get a defense bill in the next week or so. And then as far as Build Back Better, I think that gets pushed off by quite a bit, and we still have not heard anything definitive from Joe Manchin.
Well, there's the Build Back Better question. Of course, there's already been the bipartisan infrastructure package passed, and the president is traveling the country touting that. Given that so much of that won't actually be realized until years down the road, is that going to have any real boosting impact for Democrats in the midterms?
Not really, no. I think, Haley, it's going to be difficult for the Democrats to have a lot to brag about. There's still going to be urban crime. There's still going to be issues. And as we've been hearing all morning, there's still probably going to be inflation, a lot of it next year. So this is a pretty grim outlook for Joe Biden with his job approval rating sliding. They lose the House for sure. The Senate is still maybe in play.
And for the Democrats, especially in regard to the debt ceiling, given that is somewhat of a deadline before the end of the year, is Schumer going to have to cave because any default or the prospect of it that maybe strikes fear in the markets would be blamed on the Democrats?
I think he has to cave. I mean, he would like to get Republican fingerprints on it, but Mitch McConnell will not allow that. So I think you'll see Schumer in the next week or two cave. If he doesn't, there might be another extension. If there still isn't anything, the Federal Reserve would have to step in as a last resort.
Greg, I want to turn to your New Hampshire. You and I over the years have always identified with what's going on in New Hampshire. I am absolutely thunderstruck by the COVID statistics out of New Hampshire. They must distress you deeply. Can you give us a why? Can you give our global audience a why of this little island of beautiful green mountains in New England struggles with COVID?
Well, it's nationwide. I mean, we're losing over 1,000 people a day. The numbers have been horrible lately, and that's got nothing to do with the new variant. It's all Delta. But in New Hampshire, I mean, there are a lot of people who don't want government to tell them what to do. People are very independent. They don't want to be pushed around. But you see these waves come in different states in different weeks. It was a week ago, it was Minnesota. A week before that, it was Michigan. So I think you have to conclude we have not turned the corner yet fully on COVID.
And in the meantime, Greg, policymakers are changing the way Americans engage with society. That's taken place in New York City. To go to a restaurant now, just to eat, you need to show your vaccine pass, you need to show photo ID. And Greg, I wonder how long before we start having this much bigger conversation about a very sensitive issue in America for a number of years now, photo ID at the voting booth. Greg, how do you think that changes? Does it extend towards that, something that Democrats have pushed back aggressively against Republican demands over the last few years?
You may have to see something stronger. Again, I don't think we're out of the woods. My wife and I canceled our trip. We always go to Europe in Christmas time. We cancel. I think there's a chance of quarantines. So there's still big complications, and one of them would be photo IDs, no question, John.
Greg Valliere, thank you, sir, of AGF Investments. Tom, we've talked about this through the last 2 years now. Every time there's a policy shift, We're asking how much of it sticks beyond the pandemic. How much of this becomes the so-called new normal?
Well, the new normal is adjusting here in the Omicron, and we don't need to walk through the different news that we have on Omicron today. The news tomorrow will be different as well. But I do take Greg's point on in what Kayleigh said about New York City, that there's clearly a trend here to politicians who are flat out exasperated. John, I do point out that if quarantine is issued within Italy, there's a hotel on the canal in Venice that possibly we could quarantine.
You're thinking of quarantining there. Would it be vacation cancelled, Tom, if that got introduced? On the way back, if you had to come back to the States and quarantine for 5 to 8 days?
Maybe we go down to Naples and go off to Capri and stay.
I'll join you. We can do the show there in Capri. But in all seriousness, Tom, that would totally devastate hospitality over the holiday period if that got introduced.
And John, this is important. The leader of Italy, Mr. Draghi, has made clear tourism matters.
Big time in Italy.
Yeah.
And in Spain and others too. Coming up, Bill Lee, looking forward to that, the chief economist at Milken, on China as they deliver a required reserve ratio cut. Yields are higher by 4 basis points on 10s to 138.17. Equities are positive, 1/3% on the S&P 500 from New York City. Heard on radio, seen on TV. This is Bloomberg Surveillance.
So what happens is that we create some icons, we call them tags, and they have a signal within them. And when you stare at that, your eye responds to it in a particular way. So the way in which that eye response occurs is a signal that we pick up on the visual cortex of the brain at the back of the brain. So the sensor is looking for the signals we create here that come through the eyeball, through the brain, and then onto the visual cortex. Once we've got it there as a signal.
Lee, he is chief economist at Milken, but far more truly expert for the International Monetary Fund on the Pacific Rim and China. Bill Lee, what do we get wrong in the United States of our stereotypes of what we think of is Jonathan Spence's ancient China, the World War II China, or what do we get wrong about present-day China?
We have this image of China as a monolithic behemoth that is moving in unison, and I think that's far from the case. Right now, there's a huge amount of debate and dissension within China as to how to sustain growth, how to manage the property crisis they have there, at the same time, inspire the people to go out and spend.
Okay, traders, position opened. We open long position on Bitcoin. The price, you can see, 48,399. Okay, we're long. All of you guys who was patient and placed an order to buy Bitcoin about an hour ago, well done. You in, stay with me, and I will guide you through this trade when we will close this trade in profit. I'll speak to you later, guys.
In China, Bill Lee, what I hear from experts is the monolithic view of President Xi is just flat out wrong. How powerful is the Beijing leader?
he's become more powerful. I think that's the key message that's going to come out of the next People's Congress. Xi Jinping has done what only two other leaders in China have done, Mao Zedong and Deng Xiaoping. He has become declared core leader. And in doing that, he's essentially gotten rid of all of his opposition. His anti-corruption policies have really gotten rid of any kind of challenge to his leadership. And his strategy is to consolidate by telling the people of China the Communist Party is going to deliver them safety, growth, and a better way of life by doing what Mao did, which is to say, turn domestic, turn inward to sources of growth and sources of export growth. And I think that he's going to try to tell the world, we will be a major power, handle us as such. But at WTO, he's also saying, we're also an emerging market. We want the advantages of being an emerging market. A lot of tensions there.
Bill, just want to jump in with a stock move. Tesla down by 3 percentage points in the pre-market, some headlines crossing. Katie, what do you see?
Well, it's reportedly an SEC investigation that has been opened. This is according to a report from Reuters. You are seeing the subsequent move in Tesla shares, and we understand from Reuters that this probe is over claims on solar panel defects. So related to that Solar City acquisition, I'm assuming, but we will continue to monitor Tesla, of course, John.
They can't shake that off, can they? No. That's the Reuters report. The stock's down about 3%. We'll revisit that a little bit later in the morning on Bloomberg TV and radio. Bill, I want to return to the leader of the Chinese Communist Party and try and understand from your perspective how much strength he actually has in China right now. Because on the outside looking in, we see these lifelong term limits for the Chinese leader, and then we try and figure out how much strength, how much control he actually has, Bill. How much control does he have?
That tension between what he does at the federal level and what power Beijing can exert and what the local authorities are able to implement are really two different things. The local authorities are caught in this place where they need revenues, so they've got to sell a lot of property. Beijing wants to crack down on property companies expanding credit too much, and they need to cut down on property being the only source of savings for the people of China. So the fiscal authorities have to expand the portfolio of assets available. The local authorities want the property market to be the core place that they will get their financing from. Lots of problems there.
What I've always found amazing, Bill, is how much faith, confidence they seem to have in the Chinese policymaker when they make a move and do things like this, that China has control, that they can let some of the steam out and then they can support things again, tap the brakes, support things again, keep doing it over and over again without making a mistake. Bill, as you look at things, what is the risk of a policy mistake as they try and engineer the inevitable soft landing that is nearly always around the corner for China? When does it become something else, something to worry about, Bill, and what does that look like?
Keep an eye on what they've just done. They did a triple R cut, right? They've cut their reserve requirements, which in the most economists would say that's expansionary. That's going to expand the growth of credit. At the same time, I just told you they're trying to deleverage like crazy. Now, how are they going to pull that off is something that's very important, because they also have to accept that China's growth target is going to have to reduce down to 5% or even below 5%. This next quarter, we're expecting GDP to come in at 4.9%. One of the things that the demographics and their shift toward higher value-added GDP activities is lots of manufacturing activities leaving China. That's the source of job growth for a lot of people. What are they going to do about that?
Billy, Kaylee Lyons mentioned 2 hours ago the modest uproar at Bridgewater of Connecticut over Mr. Dalio's comments on China. You're the kind of guy who sits in fancy offices in Hong Kong or in New York and advises Western commercial banking on the future of China and Hong Kong. What is your advice to Western bankers who need to set up shop in the shadow of HSBC?
That's the toughest job in the world, Tom. I think everyone knows the strategy for Asia in general and China in particular is diversify. You cannot put all your eggs in that China basket, which everyone thought was such a valuable basket, because, my God, look at that population. If we could just get a small share of that population, we're going to be rich. I think one of the things that we're learning is China wants to help its own financial institutions. China wants to have national champions in terms of its banking and financial system. I think the advice to anyone, including my former colleagues at Citi, is start to diversify into sources of growth in the rest of Asia, and the rest of Asia that has become less dependent upon China being the hub of the global supply chain. That's that message, I think, has to get out. But unfortunately, all of the major global banks, from Jamie Dimon all the way down to whoever else wants to get into China, is China remains their central focus because of the size of that domestic market, which I think has become less available to them.
Can Singapore and the Lee family, can they be opportunistic here?
Oh, this is an absolute phenomenal opportunity for Singapore and other financial hubs within Asia, which is to try to get that business to be where the entrepot, where the center of trade, commerce, and finance in ASEAN and the rest of Asia. I think the rest of Asia is coming together and in a way trying to de-emphasize the role of China, which China is fighting against by becoming much more militaristic, and at the same time, they're letting the U.S. become a return to be a major power to try to coordinate the kind of trade and the global supply chain restructuring that's going on.
Bill, before you go, just wanted to turn to the Federal Reserve quickly, looking ahead to next week. What are the spillovers of that? Tighter monetary policy, a faster taper to the rest of the world. Tom often talks about a central banker to the world. Does it have the same effect, the same spillover as maybe we used to talk about?
Well, it still has that spillover because we are a major cog in that global supply chain. But one thing that's underestimated is where the Biden appointments are going. I think one of the things that we have to watch out for is whether Senator Warren is going to appoint a vice chair for supervision that'll pervert the Federal Reserve's mandate into being green and one of reducing climate gap. That expanded mandate is something that I think could really destroy the capital allocation mechanism of the banking system and financial markets in general. And so that kind of distortion is something the U.S. economy may not be able to recover from.
Bill Lee, thank you, sir, of Milken, with a strong opinion at the end there on the Federal Reserve, which we'll return to another day. Looking ahead to next week, Tom, it's the big one, the Federal Reserve next Wednesday. Shortly after that, the ECB and the Bank of England.
Yeah, the Fed meeting is different now than it was pre-Omicron. We're going to have Omicron news by the time we get to the Fed meeting, and some of the economic data will come in as well. John, I'm going to go back to, I understand fancy people are all bent out of shape about inflation dynamics versus real economy dynamics. To corporations, 9% nominal GDP is just that. It's a boom economy.
Can they manage the margins, Tom, if this story persists?
Okay,
They've done it time and time again, quarter after quarter through this year. Can they repeat the act in 22?
Would be optimistic. I think history tells us that the gloom crew always overemphasizes margin erosion.
If there was a top 10 list of questions next year, Kaylee, that would be a feature on it.
Yeah, and it was a feature this year as well. And as you said, that hasn't really proven out. What is interesting is companies have been able to pass on costs because consumers have been able to continue to spend because they have a lot of savings that they can call upon. Once that starts to be driven down in the face of still elevated prices and you're not seeing the wage gains necessarily to keep up with that, does the ability to pass on those costs start to get a lot more difficult?
I think this was the point someone was making earlier this morning, Kaylee, whether the consumer price tolerance now has been totally eroded. Whether that safety net that was built up over the last year or so, whether we've taken a big chip out of that going into 22.
Yeah, exactly, because you aren't seeing the wage gains. Yes, you had all those savings because of fiscal policy. That fiscal impulse is no longer there. That stimulus is no longer there. And the question is going to be, as we look forward into next year, if these price pressures do prove more persistent and there isn't that extra money coming into consumers' wallets, what happens then?
Are we doing this again tomorrow, or does Lisa return?
She's scheduled to return.
She's scheduled to return. I was just wondering if that was the warm-up act for Lisa's return, Tom. Is that what you said as well?
That's what I heard there, yes.
Channeling Bramo for Bramo's Bears this morning. Futures up 19, let's call it 20 on the S&P. Positive by 0.4%. We turn around. We were briefly negative. NASDAQ futures off the lows as well. We're down just 9 or 10 points on the NASDAQ 100 now. Negative about 1/10%. Victoria Green, the CIO at G Squared Private Wealth, is going to join us very shortly around the opening bell. We'll start that conversation with her in about 20 minutes' time. From New York City, kicking off a brand new trading week and counting you down to the main event. It's CPI on Friday. Your median estimate, 6.8%. Sarah House of Wells Fargo with us this morning. Talking up the prospect is 6.9 on Friday and averaging 7% CPI through Q1 of 22. It's crystal ball season. More outlook still to come. From New York City with Tom Keene and Katie Lyons. I'm Jonathan Ferro. Lisa back with us tomorrow. Heard on radio, seen on TV. This is Bloomberg.
With the First Word News, I'm Rishka Gupta. A new report from South Africa says that so far the Omicron variant hasn't led to a surge in hospitalization. South Africa is the epicenter of the outbreak of the new strain. President Biden's chief medical advisor, Anthony Fauci, says that whilst it's early, it doesn't look like there's a great degree of severity caused by Omicron. The U.S. reportedly will declare a diplomatic boycott of the Beijing Winter Olympics. According to CNN, the decision not to send any U.S. officials to the Games in February will be announced this week. The move would be largely symbolic. Few U.S. officials are likely to visit China anyway due to strict quarantine rules and clashes over human rights. Saudi Arabia is signaling that it sees demand for oil staying strong despite the spread of the Omicron variant. The Saudis have raised prices for buyers in the U.S. and Asia. The move comes days after OPEC and its allies surprised traders with a decision to boost the oil output. And DoorDash is launching an ultra-fast grocery delivery service. It will be staffed by full-time workers with traditional employee benefits instead of the large freelance workforce that the company built its business on. DoorDash faces increasing competition in the grocery delivery business from startups such as GoPuff and Joker, which rely on full-time employees. T-Mobile's merger with Sprint was supposed to create a supercharged wireless competitor, but the company appears to be losing one of its edges, customer service. In October, Consumer reports that T-Mobile has slipped from above average to just average on consumer satisfaction. Another survey showed T-Mobile fell from best to worst amongst major carriers. The company says it's working to fix the problems. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts. I'm Rishka Gupta. This is Bloomberg.
Competition is going to look like? Do you think there is going to be a price war? As you say, the fares are available now. You're suggesting they may not be there for forever, but nevertheless, talk to me about what you think the competitive landscape is going to look like here.
We've seen a bit of departures in this market, and this market has three very strong joint ventures that compete head-to-head daily to win the hearts and minds of consumers and businesses in the United Kingdom. So I don't see a difference in the competition. I think we've all focused on Heathrow as the major hub in the United Kingdom, connecting, of course, the U.S., New York, Los Angeles, and other locations. So I see this as a continuation of competition. We've been waiting for the day that we can compete strongly in the marketplace after such a long period of time where it's only been one directional traffic from the U.S. to the U.K., and now it's open, of course, to U.K. nationals.
You mentioned Heathrow. What about Gatwick?
We made a very tough decision in March of last year to really focus our efforts at Heathrow.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
So do you ever commune with Conrad Hilton? Do you ever get any messages from heaven from him saying you're doing a good job protecting my name?
I haven't, but I did meet his son, Barron. He was quite proud of what we had done with the company and suggested to me Conrad would have been as well.
The world's urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
Since the end of October, the average weekly price of gasoline on the wholesale market, that's what you sell to the gas stations, has fallen around 10%. And that decline has picked up in recent days. That's a drop of about 25 cents per gallon. These savings are beginning to reach Americans.
The President of the United States, Kayleigh, I'm sorry, he's got a cold. He sounds like Tom Keene. He's got
a deepening of the voice. It's a voice for radio.
We welcome all of you on radio and television, and this is the conversation of the day across this nation on oil. To review here, and last week I thought that Bloomberg is a company was exceptional on driving the hydrocarbon story forward. Those looking for a new level of $80 or even up to $100 a gallon. Barrel, I should say, or even higher, as J.P. Morgan calls for, and then abrupt opposite views led by Deutsche Bank. It's a battle out there over the gaming of oil. Amrita Sen is with Energy Aspects, and to make it clear, she is hugely qualified to look at the global dynamics here and fold them down to her microeconomics of the University of Warwick of a few years ago and a few other selected schools as well. We are thrilled to welcome you to Bloomberg.
Thank you.
In New York. Nice of you to be here. Here's what I saw in a 32-page J.P. Morgan PowerPoint. There is an assumption by the oil price bulls that it'll be different this time, that shale oil production will not come in as oil price goes higher. What do you say on that?
Yeah, I think the price elasticity of shale production has changed, dramatically changed.
This is not 3 or 4 years ago.
No, it isn't. At least right now it isn't. I was in Texas last week, met with lots and lots of shale producers, and it's a very different mood. In fact, some companies who initially said they'll grow by 5%, they revised it to 0% and their share prices rose. So why would they increase production? But also, they are facing huge constraints, labor, equipment, steel shortages. So a lot of them are postponing rigs.
Are they COVID constraints, or is it something that clears with a better pandemic environment?
The supply chain shortages will clear, but it'll probably still take a year. Right now, if you order a rig, you have to wait over a year. It used to be 3 months. Those things should ease over time.
But is that true in Saudi Arabia as well?
Probably not as much, but then again, they don't need as many rigs, right? Shale just requires a lot more. But ultimately, shareholders are not rewarding them to raise production. That's the biggest fundamental difference this time around.
Okay, that's on the shale side. When it comes to OPEC Plus, they surprised the market to a large extent last week when they decided to proceed with a production hike in January. Do you think that means that they will then have to slow or dial back in the following months?
I think a lot will depend on how demand is doing, or the headlines you get because of the new variant and potential new flight restrictions. I think that is going to be absolutely critical in determining what OPEC Plus do. Given the fact that the group has, the current meeting is still ongoing in theory, they didn't adjourn it. Very clever move, because essentially that means that, there's enough uncertainty amongst traders that they're not going to go necessarily short this market. I wouldn't rule out a pause or a cut if demand numbers get worse and if the headlines get worse going into the 4th Jan meeting.
What would you need to see that you would consider a headline getting worse? What is the real risk to demand from the Omicron variant?
The WHO, I believe, are holding a press conference this week. I think OPEC Plus will be listening to that very carefully. And I think for me, the critical thing is going to be how much more travel restrictions are we going to get in the next couple of weeks. A lot of countries are already tightening up travel restrictions. And, we are in a constant conversation with OPEC member countries and ministers about the impact on jet fuel demand and overall demand. I think they are going to be looking at that very, very closely because on their own numbers, Q1 builds are huge, close to 3 million barrels per day. So any drop-off in demand is just going to make that even worse.
So demand elasticity is still there, still visible, and am I right, an unknown?
Absolutely an unknown right now because, we just had started traveling. I mean, this is my first trip to the US since March of last year. Now, more testing required and just more, it's a bit more onerous right now again. A lot of people were planning Christmas holidays. Let's see how much of that actually goes ahead. But I will say this, look, there's a lot of pent-up demand. I mean, in Texas, at least traffic was as insane. In Asia didn't have a summer this year. They were still in forms of lockdown. There is a lot of pent-up demand amongst consumers to go out there and travel.
So what is your call on oil as we speak to all these experts, some of them in the bright lights of major firms and all that? Just to color it, is $80 the new $60? Do you see a trend up to the headline grabbing $100 a barrel?
We've had 85 for 2022 for over 3 years now. It was based on the thesis of underinvestment and that shale is not going to react in the same way. So we're not changing that. It's structurally, yes, you're exactly right, 80 is the new 60. Now, to get us to $100, we need an event. There's plenty out there.
Sure,
Libya,
and
Nigeria.
Others say that. Yeah,
yes,
absolutely.
but I don't see us going to $100 in the near term. Ultimately, COVID is still around, and that's capping demand. So we really need to look through to 2023 when the real supply shortages kick in. That's when you can see $100.
And we learned overnight, Amrita, that Saudi Arabia is raising prices for buyers in Asia and the U.S. What kind of signal does that send to you?
So the Saudi OSPs, the official selling prices, they are based on a formula. The formula was suggesting an increase in price. So it's not a surprise to us. If any, you could argue that the increase is a little bit more than the market was expecting. But again, going into this meeting, we were being told that, look, a pause could happen, even a cut could be on the table. And then politics got involved and, we saw what OPEC Plus had to do. But Saudi Arabia, for one, is absolutely not keen to allow a surplus to build. Increasing prices to key consumers suggests that, look, they are going to keep a restraint on supplies.
Amrita Sen, thank you so much for joining us. Don't be a stranger. Wonderful to have you here in New York, and we hope to see you in London soon. Futures up 18, Dow futures up 230. The VIX comes in. We had a 31 VIX in the angst of Friday, Kaylee, into 30 today, and 29.44. It's still elevated, but not what we've seen since Friday, 12 noon.
Yeah, a little bit lower than Friday, but still materially higher than we've seen in months, Tom. We've been hanging out sub 20 on the VIX for some time, and you saw the sudden bout of volatility. The question is, are we going to continue to see elevated volatility into year end, especially as we look ahead to the Fed decision next week and investors try to digest what exactly a more hawkish Fed would actually mean for risk assets?
Research calls for those of you greeting the morning here in New York. Betsy Grasick over at Morgan Stanley throwing love to Wells Fargo and Goldman Sachs. Kit Jukes at SocGen, Kaylee, with that euro call to a 110, a weaker euro, and even framing out a 105. That gets my attention.
Yeah, to be sure, 110 isn't all too far away. We're looking at a 112.97 on euro dollar this morning. 105, though, that is an entirely different animal that I don't think many people are prepared for, Tom.
Just here in the blinking of the Bloomberg terminal, Lira has just now lifted up a 13.80. What's important on something we haven't mentioned all day is Turkish lira now sustaining at those ever weaker levels. It's not a record weakness for lira, but in terms of just the persistencies there, 13.80 is a weaker lira today by 0.7%. Thank you to Damian Sassower for wisdom as well this morning. We are looking to Friday and the inflation report, but so much more to talk about on the way to that, including the politics of the Republican Party in New Hampshire. Chris Sununu, the governor, in the 12 o'clock hour. Stay with us. This is Bloomberg.
60 years ago, this was the site of a bitter battle between India and China. 6 decades down the line, the two Asian giants are again engaged in a bitter border dispute. The 13th round of talks have ended in a stalemate. As the winters creep into the Himalayas, both sides have reinforced, and soldiers are hunkering down. India has reinforced its positions all along the line, bringing in additional troops, tanks, guns, UAVs. Clearly, neither side are taking any chances.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Let's get your trading week started from New York City for our audience worldwide. Good morning, good morning. Your equity market with a lift up 20, advancing 0.4%. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Farrow.
From New York, we begin with the big issue, a taste of things to come.
Expect heightened volatility. Volatility. A lot of uncertainty.
A recalibration of equity risk appetite.
Wacky market environment.
And that's because the Fed is taking away the punch bowl, possibly.
There's uncertainty around inflation, around the Fed's reaction function, and around COVID and the variants.
Look at what we've heard from Jay Powell.
Jay Powell saying it's time for them to exit the market.
This tells you that the Fed want optionality.
It does raise the stakes for the December meeting.
This all comes back down to inflation.
The potential for this accelerated taper.
Look at how markets are now priced for next year.
The market has pulled these rate hikes earlier.
There's clearly more pressure on the Fed to act now.
This is a bumpy ride. There are plenty of risks.
There always are. Joining us now to discuss is Neuberger Berman's Ashok Bhatia, Toll Backen's Michael Purvis, and Victoria Green of G Squared. And Victoria, I want to begin with you. Are we getting a taste of things to come?
Yeah, I think we always expected that when the Fed was going to step out of the market a little bit. It always heightens volatility. But we look back at 2015, 2016, and there are going to be a couple knee jerks down. But the Fed ending tapering and raising rates is not a death blow to the equity markets. You know, it might be a little rough in the fixed income markets. You're seeing the flight to quality and you're seeing the NASDAQ take it a little bit harder. But those are all a little bit expected. You know, you're going to see the Fed have to move a little more aggressively. The market's priced in almost 3 hikes next year at this point. So I think the volatility is here to stay. But we were in a period of almost record low volatility. So some of this is just mean reversion.
We need to build on what it means for equities. Ashok Bhatia, I know you've got a view on this, not just a taste of things to come, but maybe a glimpse of the next 12 months, Ashok. Why?
Yeah, our view is that this is going to be, 2022 is going to be macro volatility. It's going to be some of the things I think Victoria just mentioned. It's going to be Fed hikes. It's going to be virus. It's going to be those kind of things. But one thing we come back to is that growth in the U.S. and Europe and probably the world is still going to remain pretty robust and in many places above trend. And that means fundamentally a lot of pockets of fixed income credit investments are going to be good places to be. So it's going to be an environment where when credit spreads widen like they have, there'll be some opportunities. And, as they were a few months ago, that's when you take a little bit of risk out of portfolios.
Michael Purvis, this was the view from TD. It will be a close game of chicken into mid-22 between market fears and macro facts. Do you agree?
Well, sure. I think we're going to really sort of see a kind of a dynamic and sort of somewhat confusing inflation discussion into next year, which is going to create all sorts of interesting opportunities. I'm not exactly sure what that quote exactly means here, but I would certainly say this, that when you're coming from a Fed policy that was extreme coming out of COVID, looking at a 2022 nominal GDP picture in the United States of 7 to 8, maybe higher percent, that's going to set up, I think, a lot of this volatility that we're seeing is very understandable in that context, right? This regime shift is something at the Fed that is something we should expect, and it's really not that. It's confusing in the short run, but it's really not at all unconstructive for risk assets into next year.
You brought up that line, regime shift, and Victoria, I want you to add to that just how much of a different market environment you expect to see through 22 based on what we're learning so far.
Well, I don't think it's different. I think we've seen this so many times before, and I think that's one of the dangers of investing is what I call the 4 most dangerous words to investors. This time it's different. It's never different. We think it might be different, but it never will be. So we've seen this before. We've seen tapering. We've seen rate hikes. We've seen a hawkish Fed. We understand what it's going to mean to the markets. I think news travels very fast. We tend to like to get worried these days. But honestly, a worried market's a great time to be an investor. A scary time to be an investor was when everybody agrees everything's great and everything's bullish. And that's tend to be when it falls apart.
That issue, though, that you brought up, we've seen this before. The Fed gets too hawkish. The difference, though, Victoria, the Fed can then back away. There are people asking...
Counterpoint to you. So we all think inflation is because of supply chain issues and labor market issues, correct? So what exactly does a Fed rate hike do to help solve those issues? How does a Fed rate hike actually help solve a supply chain backlog? Some of these inflationary issues are a little bit harder to solve because of how they were caused. So I'm not sure that the Fed tools are more helping the markets, but the markets themselves, the labor market and the supply markets, are just having to unwind the train crash that was COVID. So I think you're going to see both of those things play out in 2022. But one of the things I think Powell is really thinking hard about is, okay, this is the playbook. I have to raise rates to help offset inflation. I have to stop tapering. We need to tighten. But at the same point, if you look at the root causes of inflation, some of those are a little harder to fix than just a Fed rate hike.
It's a really, really good point. And I'd go one step further. Deutsche Bank are raising this too. Given where nominal GDP growth is right now, Ashok, does 150 basis points of tightening get it done? Does that slow nominal GDP down to a more sustainable 4% pace?
Yeah, well, 150 basis points of tightening next year will have some impacts on GDP, and it might just be via the financial conditions channel. I would expect that's going to be an environment where, a lot of risk markets and the dollar are going to do a bit of work to slow down growth. But, I think on the inflation front, we're in the camp that it is going to come down next year. Some of these things on used car prices, goods prices, consumers returning to spend a little bit more on services than goods. The expectation, and we shared, is that inflation's headed lower next year. The debate is how much and how does the Fed react? And, I think one of the reasons the Fed wants to keep a bit slower taper is to give themselves some room to maneuver. They'd ideally like to see inflation coming down pretty quickly in the first half of next year and allow them to have the optionality to defer rate hikes. But 150 basis points of hikes next year is not what we're expecting.
What are you expecting, Ashok?
We're expecting about 100 next year, so we do think the market will be a little bit more aggressive than the Fed, and it will be something we are expecting to hear in the market from the Fed later this month. that the taper is going to get accelerated. So something that maybe it's going to end in spring of next time. But we do think there'll be a bit faster adjustment than what the Fed's pricing to get to something like a 1% funds rate.
And Michael Purvis, it raises a question, reminds me of some research that Savita Subramanian put out at Bank of America last week. What happens to the TINA argument if cash yields rival the S&P 500 1.3% dividend yield, and if the 10-year hits 2% by year-end next year as they expect? What would happen?
Well, look, the dividend yield on the S&P 500 is only one facet of the equity case, right? I mean, there's the call option on future earnings growth there as well. Look, if the 10-year yield is going to be noticeably more attractive than the S&P dividend yield, that's one facet of TINA there, but it's not everything there. And I think, I still am of the view, I think my year-end call, I've been resolute at 1.3 for this year, and that'll come up next year a bit, but I still think when you think about equities, you have to look at it in terms of the equity risk premium. In other words, the forward earnings yield less the 10-year. And right now it's at around almost 3.5%, which is a very healthy level if you take the view that the 10-year is not going to fall apart and yields are going to spike to 2.5% and 3%. So I think that's going to keep reinforcing the case that you're going to be forced up the risk curve. You're going to be wanting to be long S&P through next year, unless earnings really just collapse, and I don't see that happening.
Is that basically your conclusion as well, Victoria? Is that your view?
Yeah, we'd like to be a little more value focused. The S&P is really, being such cap weighted. And if you look at the top 10 holdings and what really drives it, you are still pretty tech heavy. We think value is a really great place to be a little more cyclical. That'll also help you pick up a little more yield. The energies, the financials, the industrials. I think those are some better plays right now. As you can tell, tech has been difficult, and some of that might be with the potential of the 10-year and rates coming up and not hurting the discount rate. But we think the market is certainly where I want to be. We are overweight equities going into next year. I think the fixed income market bears just as much risk as the equity market with a much lower potential return. So absolutely, we're keeping our overweight in stocks, but we would tilt a little more value and maybe not quite overweight the S&P 500, but overweight the Russell 1000 value.
Ashok, just to summarize what Victoria just said there, the risk reward is better in equities than, say, credit right now. How would you respond to that, Ashok?
We are in a low rate, low spread environment. And so for investors that can look across a range of equities, alternatives, fixed income, I mean, it is hard to argue that fixed income is got the highest return expectations. But, there are a lot of investors globally that are constrained and need to invest in fixed income. And within the fixed income markets, our view is that with this recent widening, there's finally some value being created in some fixed income credit. And if we see further widening into the end of the year or early next year, one should be buyers in those markets.
There are always risks to worry about. Barclays went through a few of them. The list of potential worries is long. Slowing growth from where we are. 69 handle on the ISM. Maybe that's in our future, given where we're at right now. Rising inflation, tightening by most central banks, less fiscal support, new COVID variants with related restrictions. Michael Purvis, to just put a bow around this, they say the bear case is the easy one. But on this list of major concerns, it's not filled with fundamentals. Can you just conclude that for me, Michael? Would you agree?
Well, I'm not sure I would agree. I think there's a lot of cross currents in the price action over the last several weeks. So many hedge funds have been on the wrong side of the steepener trade. They've been on the wrong side of various shorts or various longs within equities and so forth. If you look at CFTC positioning, just last week you had a surge in SPX longs and a surge in 10-year Treasury note shorts. There. So, I think there's a lot of ascribing narratives to sort of offsides positioning there. But I think at the end of the day, the large allocators that are making strategic decisions as to whether to commit to, say, treasuries, credit, or equities, I think the buy equity case is going to really continue to persist. And for all the noise and economic and inflation prints and all the confusion that we're sort of seeing at the Fed, if you will, I think the market's going to be able to sort of muddle through that sort of haze pretty well and continue to sort of grind higher because the numbers just set up that way. Unless you come up with some sort of real economic out of consensus bear case on the economy.
Well, we get to the noise and the signal, if there is any, in this bond market in just a moment. Michael, Ashok, Victoria, sticking with us. Coming up, markets weighing improving economic data against Omicron concerns.
We're still dealing with the coronavirus. We're looking at the new variant now to see what the impacts that'll have. But overall, we feel good. I feel good about where we're going as an economy here.
The latest up next from New York. This is Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Thus far, it does not look like there's a great degree of severity to it, but we really got to be careful before we make any determination. We feel certain that there will be some degree and maybe a considerable degree of protection against the Omicron variant.
Dr. Fauci weighing in on the spread of the Omicron variant as cases rise throughout the world. The president of Moderna raising concerns about vaccine resistance, speaking on ABC's This Week.
I think that there's a real risk that we're going to see a decrease in effectiveness of the vaccines. What I don't know is how substantial that is.
Let's bring in Bloomberg's Michael McKee on a week ahead and what we're learning so far. Morning, Mike.
Good morning, John. Well, from Wall Street to Main Street, there are two main questions out there, and that is how fast does Omicron spread and how bad is it? Well, so far, the data does seem to show it's spreading around the world. We're up to 45 countries, 17 states in which cases have been found. However, we don't know whether that means it spreads a lot more quickly or whether we're just finding a variant we weren't looking for before. Initial data, though, from a hospital complex in the heart of South Africa's Omicron epicenter show that while COVID-19 case numbers have surged there, patients are needing less medical care. Things aren't as bad. You heard President Biden's top COVID advisor, Dr. Fauci, endorsing a semi-positive view so far. The U.S. is reevaluating its ban on travel from southern African nations, he says. That is not good enough for New York City. The mayor announcing this morning the city is imposing a vaccine mandate for private sector workers as of December 27th, going to require residents to be fully vaccinated as well to access indoor dining, entertainment, and fitness. It's also not good enough for Goldman Sachs. While COVID researchers haven't seen enough data on Omicron, Goldman's economic team has. They see it exerting only a modest downside drag, cutting their GDP estimate to 3.8% from 4.2% this month. Again, we don't know what is going to be happening, and it is kind of a quiet week ahead of the Fed meeting. No Fed speak. The Fed doesn't know what's going to happen with Omicron, but consumer prices are the big story of the week. They'll be out on Friday, and they won't tell us anything about Omicron because it didn't really show up till the end of November, and these are November numbers. So, John, that's the lesson so far. It doesn't really matter what Omicron will do. Delta is still bad enough, and we're still dealing with COVID.
Outside of all of this, Mike, there's basically 3 days left. There is Friday, there is next Wednesday, and there is next Thursday to get to the end of the year. On the optimistic side of things, anyway. Michael McKee, thank you, sir. Good to catch up. Mike mentioned that Goldman call. Here's the quote from their research. While many questions remain unanswered, we now think a modest downside scenario where the virus spreads more quickly, but immunity against severe disease is only slightly weakened is most likely. That's the view right now, an early view, an early consensus starting to form. More data still to come over the next couple of weeks. Back with us, Ashok Bhatia, Michael Purvis, Victoria Green. Victoria, there are so many people out there right now that just don't know what to do with this conversation around this new variant. What are you doing?
So first, I always look to historical data, and it's not much. I mean, we have, what, a year and a half of this now, but, you know, we saw what Delta did, and everybody had these great fears of Delta as it came in. But over the summer, when Delta was really surging, the markets were up 8 or 9%. So if you look at this and you take out of context potentially your own personal fears, and you look at this more economically, market speaking, fundamentals of stocks, we think this may be a little bit more of a nothing event in the markets like Delta was. It's very promising that the data seems that it's less harsh. You know, there were something like 32 mutations on it, so obviously it may spread quickly but be a less deadly variant. I definitely think everybody needs to take a step back. I think what happened in the market was an oversell because we really don't have any data yet. Everything is just a hypothesis, and you want to be making your investment decisions based on data. Fear is a powerful thing, and we see that time and time again with investors, but it's a horrible strategy to allow fear to drive your investment policy. And so that's why we think we may still see a little bit of a Santa Claus rally as some of these fears and some of the data actually comes in. And you're going to make adjustments. You know, you're going to see cities or states make their own policies. But generally speaking, we don't think this is going to be a drag. And we'd agree with Goldman. If anything, I don't think it's going to be any drag at all. And that's why we remain overweight in the energy sector. And that was probably a massive oversell.
This market right now has made some big moves as well. We're trying to adapt to the incoming information. Michael Purvis, you said something interesting about 5 minutes ago when you said, are we assigning a fundamental narrative to just moves where people got caught quite offside in the bond market, in equities? What do you say back to that? Just build on that for us, Mike.
Look, I mean, you know, there's always fundamentals that take a bit longer to sort of really manifest themselves and play out there. But, you know, we've had a year where, you know, a lot of hedge funds have had tough times, you know, on the short side, on the equity side, like we talked about, certainly on the steepener just a few weeks ago. And that price action, you know, that sort of overextension just can really drive pretty crazy price action sometimes, and then everyone feels compelled to come up with a narrative to explain that there's a fundamental reason behind the price action when sometimes it's just a risk manager tapping a PM on a shoulder or a collection thereof there. So I think that's something you always have to watch for when positioning does get extreme, and you're reading articles about people getting taken out there. I think it's pretty obvious that there's a lot of you know, just sort of cross currents there that present investment opportunities if you're not caught up.
I was thinking of that on Friday. I thought of that on Friday, Ashok. Everything Michael Purvis just said. When we saw that payrolls report, when we saw the ISM with a 69 handle, and then saw Treasury yields end the day 10 basis points lower on 10s. Can you help me work through that, Ashok? How you explain that move on Friday and just the day-to-day price action at the moment?
Yeah, I think one thing that's going on in the bond market is the repricing of inflation break-evens, and this kind of gets into why yields are falling or stable, which is we have seen a retracement in inflation expectations. So in the U.S. market last couple of weeks, you know, 10 to 20 basis points in the 5-year to 10-year space. And so part of what's going on with nominals, we think, is as inflation break-evens are moving lower and the market expects, falling inflation, or at least not the same levels we were, the market is kind of keeping real yields around these same levels. So it's an environment where inflation expectations come off, but real yields stay broadly stable, and that's feeding into this movement in nominal yields. So I do think, though, the positioning issues are there. There are some, I think there's probably some positions that were set on the idea that Fed is going to accelerate tapering, inflation's no longer transitory, and then, the number was a good number, but perhaps not strong enough to validate those positions, and some risk gets unwound on that.
Normally functioning markets, though? Is it normal from your perspective, Ashok? Anything to be concerned about just in the day-to-day functioning of Treasury markets at the moment?
Now, this is all, we're not seeing anything that's like, ringing alarm bells. Certainly in the credit markets, we've seen the liquid names underperform less liquid names. That's pretty typical in a sell-off. We're seeing cyclicals underperform defensive. So, I think the broad mosaic of what's going on in the markets is fine. Now, is liquidity what it was 10 or 15 years ago? No, but these markets are functioning and liquid, and we're not seeing anything that's, ringing alarm bells.
Treasury yields all over the place. Friday down 10 basis points this morning, up 3 to about 138. Ashok, Michael, Victoria sticking with us. Coming up, the morning calls, and later, investors positioning for rising interest rates, fueling an exodus out of some of the market's most expensive stocks, and raising some big calls from Morgan Stanley on the future of the likes of Wells Fargo. We'll get into that in a moment. From New York City, up 26, advancing 0.6%. This is Bloomberg.
提前的就是步入工作岗位，然后对这个工作更加熟悉，然后调整好心态，就能够在赛时去一个更加自信、更加昂扬的一个姿态去迎接来自世界各地的代表团的外宾们。
Following a week of losses on the S&P 500, looking to bounce back by about 5 or 0.6% on the S&P, on a Russell up 0.9 on the Nasdaq. Deeply negative earlier in the session, down about 0.6%. Right now on the Nasdaq 100 up 20, advancing a little more than 0.1%. That's the price section. Here are your morning calls. We begin first up with Morgan Stanley, upgrading both Goldman and Wells Fargo following recent declines. The analysts seeing limited Omicron risk with higher interest rates fueling future upside. Wells Fargo, the big call from Morgan Stanley this morning. Next up, Citi upgrading Electronic Arts to a buy. The analyst highlighting an impressive balance sheet and attractive risk-reward profile. That stock is up by 2% to 127.74. And finally, Cowen naming Micron one of its best ideas for 22. The analyst expecting shares to benefit from rising demand and decreasing supply of memory chips. That stock is negative 0.25% to 81.41. Coming up, big tech falling out of favor, a 2-week rout in the Nasdaq 100, wiping out roughly 1.7 trillion in market cap.
Urban areas are most vulnerable to climate change. Cities consume 78% of the world's energy, while also generating 60% of greenhouse gas emissions. By the year 2100, 85% of the world's population is expected to live in cities. 90% of all urban areas are coastal. And with sea levels rising, 800 million residents are likely to be affected. 1.9 degrees to 4.4 degrees Celsius is the projected increase in urban temperatures around the world by year 2100. By 2050, 1.6 billion people are projected to be vulnerable to chronic extreme heat.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Your brand new trading week starts right now. From New York City this morning, good morning. Your equity market's shaping up as follows. Up 26 on the S&P, bouncing back 0.6% from a week of losses on the Nasdaq 100, up 15 or 16 points, advancing about 0.1%. From New York City, there's the opening bout. Switch up the board and get to the bond market. 10-year yields all over the place. Negative 10 basis points on Friday. Up 4 basis points this morning to 138. In the FX market, 112.94, negative 0.2% on euro dollar. Going into next week, the Fed on Wednesday, the ECB on Thursday. And in the commodity market, 67.77, crude up 2.25% on WTI. We inch higher by about $1.50. Around the opening bout, then we advance on the S&P 500 about 20 seconds in, advancing by 0.5%. Top of the pile, materials by 1%, energy up 0.9, industrials up 0.9. A lift for financials, helped out no doubt by the bond market this morning. Financials up by 0.8%, and lagging is healthcare, up just 1/3%. Call it a quarter. Every single industry group on my screen right now in positive territory. Looking ahead to next year, this was the view of Bank of America's Savita Subramaniam weighing in on Tina.
Tina is in peril, and she needs to be careful because here we are in an environment where the dividend yield on the S&P 500 is below where cash yields are likely to be in a year or two. So, you know, all of a sudden cash looks really attractive in an environment where our economists are forecasting, you know, 8 hikes over the next couple of years. I think that's an environment where you want to own free cash flow, but you don't necessarily want to own the entire S&P 500.
We touched on this earlier. If you're just tuning in and you're confused because you're not familiar with some of the lingo, Tina is not a person. There is no alternative, just to be clear on that, just in case you accidentally chose to tune into financial news this morning and have no idea what anyone's talking about. Victoria, I want to come to you on Tina. There is no alternative. That's how we used to think about US equities. Will we still think that way next year, or are you thinking about rebalancing with a little bit more of an international tilt into 22?
Yeah, a lot of it depends on the U.S. dollar, right? And the dollar strength this year was a bit surprising to people, and it looks like it may maintain strength going into next year. And that makes it a little bit more attractive to stay U.S. We have started dabbling a little in emerging markets. You know, we tend to think that they may benefit as they get more vaccine rollout and higher growth. If we're concerned about the world's slowing growth, we too want to be in markets that may have a little bit above average growth as a way of hedging against it. But right now, the dollar's strength is something that's kind of keeping us a little bit wary of that. But we don't mind looking there. We don't mind looking at small caps, and we don't mind looking at value. I do think you need to be looking around beyond just the S&P 500, growth stocks, the FANGs. You know, we saw this last time when rates kind of came into the picture. The NASDAQ and the growth stocks tend to take a little bit of a harder fall. And so I do think you want to make sure you own things that are going to benefit from an inflationary environment, which is typically the cyclicals. And then I think you definitely want to be careful with your fixed income. I don't mind cash as an alternative, but I see cash as an alternative to bonds, because generally in a high inflation environment, you need to keep your equity stake to make sure you're keeping pace with inflation, if not outpacing it.
That final point is such an important one. Ashok, cash as an alternative right now. Can cash work in an environment where we're talking about 7% CPI?
Yeah, definitely. We think cash is going to make a comeback next year. The Fed policy rate, highly likely it's not going to be zero all of next year. And it's likely the ECB policy rate is going to be moving up over the next 24 months. So things like short maturities, floating rate securities, suddenly the income that will be available in short maturity securities is not going to look terrible compared to intermediate or long maturities. And we think that's coming.
Michael Purvis, your response, cash could make a comeback.
Yeah, I think I agree with both of my co-guests. The cash will be a lot more attractive next year. But I also want to just get back to this Tina issue, which is, you know, if you look back to 2013 and 14, where you had, you know, the relative spread of dividend yields versus the 10-year was in a much more severe pace, and the market the S&P 500 did just absolutely fine. So again, I think the Tina argument is to me, it really boils down to where the equity risk premium is. And I think that's going to be likely in a very attractive place next year. You're looking at, you know, 7, 8, 9% nominal GDP next year. That's going to do a lot for equity earnings throughout the economy.
Quick look at this equity market about 4 minutes in. The S&P 500 up 0.5%. A tilt towards financials, energy, the big winners of the year so far. Bit of trouble more recently. Financials up by 1.35%, energy up by 1.34%. Lagging information technology declining about 0.25%. On that, we can bring in Katie Lyons for more. Hey, Kaylee.
Hey, John. Well, lagging once again. Over the last 2 weeks, we've seen $1.7 trillion worth of market cap wiped off of technology stocks. And once again, it looks like tech is under the most pressure this morning for a fourth day in a row, lagging the S&P 500. At the moment, the NASDAQ 100 down about 0.6% or so, while the S&P 500 and small cap Russell 2000 are in positive territory by about 0.3. Of course, the problem here, John, is a lot of tech is very richly valued. And as Jay Powell and the Federal Reserve start sounding more hawkish, raising the prospect of higher interest rates that will end up hurting these stocks with high valuations, you're seeing that reflected in the share performance. And of course, that is true of high growth, high multiple names in particular, like those that are housed in the ARK Innovation ETF. Of course, that is the Cathie Wood's flagship fund. Did really, really well in 2020. 2021, an entirely different story, down about 25% over the last year, falling 13% last week alone. But it's not just those high beta tech stocks that have been selling off, John. The mega caps are under pressure as well. Apple and Microsoft lost $200 billion on Friday alone in terms of market value. And over the last 2 weeks, Meta Platforms, formerly Facebook, down about 10%. Amazon, Netflix, Alphabet, all have been lagging hard as well. And a lot of strategists warning there could be more pain ahead, with tightening also ahead, John.
Kelly Lyons, thank you. How much tightening? A big feature of the conversations we're having on this program at the moment. Michael Purvis, I want to go to a quote of yours. The best risk return is set up in the core of the market where valuations come down more to stories than to numbers. If you can't identify a value floor in a high-flying stock, then the stock will be the most vulnerable to any de-risking across the market. Can you just explain that line for us, Michael?
Well,
the stories, not the numbers. Just run through it for us.
Well, sure. And just to clarify, when I say best risk return, I'm looking for a risk-off market hedge. And I've been struggling all year to find, and one of the things I do with my clients is I tell them or suggest when to buy put spreads on the S&P 500 or the NASDAQ there. And I haven't done that at all this year. Typically, I do that at least 2 or 3 or 4 times throughout the year. And I haven't done it at all because I've been very constructive on the S&P 500 and also that the option market just wasn't setting up for attractive pricing. With ARKK, I did this back in January, I put a bearish trade on that. I did it again last week. There simply because I think you are, when you're starting to see sort of de-risking going on broadly, look, I can point to a value floor. I can at least identify a value floor in the NASDAQ. I can do that with the S&P 500. When you're talking about companies that are trading at 8 or 9 times sales, those are stories, right? And you can make an argument for 100 times sales or 0.5 times sales, right? It comes down to sentiment and momentum, really, as to what's going to determine the valuation as opposed to the other way around. So I just look at ARKK as, no, I'm not just picking on them. The stocks within that sort of ecosystem are just really vulnerable. And I think it's also important to point out that I don't think the ARKK ETF has it's not a core sort of institutional type investment, right? So if you're a long-term allocator, you're probably going to come into the bigger, larger cap indices there. And that's been a lot of retail. And let's face it, retail really didn't get engaged with the stock market until just before COVID. And it's been a rocket ship straight up, particularly in ARKK into about a year ago, right? And then it's been more bearish since then. But now I think it's starting to accelerate. And I think you can even see, ARKK's come in over the last couple of days. I think there's more downside to come there. But I'd also point out, John, that I think the story here is that I'm still very constructive on the S&P 500.
I hear you. And I think one of the names you're alluding to are the likes of DocuSign, that story meeting gravity, recently at least anyway. It's amazing to me, Victoria, and just to wrap up this conversation with you and Ashok now, this equity market is down about 3% from all-time highs on the S&P 500. And Victoria, we haven't had that 10% move on the index through the year so far. I just wonder, from your perspective, Victoria, why this year has felt so difficult, a year where the S&P is up 20% and change, and more recently it's felt really tough and we're only down 3% from a record.
I think we got used to just seeing green on the screen, honestly, Jonathan, and everybody now likes to make a panic. And this is the biggest drop since like November. And so we're making a little bit of mountains out of molehills. And volatility is here. Any investor will tell you, you got to be around for the dips. And we tend to be buyers of dips. But I think it just feels hard. I also think a lot of it comes into investor sentiment. And when things feel scary in our own personal lives, a new variant, what's going to happen with inflation, it feels unsettled in our personal lives, that tends to creep into the market. You tend to want to overreact a little bit and feel like, oh, the world is coming to an end. And that's where you really just want to take a step back, look at the fundamentals. Third quarter earnings could not have been better, right? I mean, it was fantastic. So you look at some of these companies, you do want to be in the right places of these markets. We don't think that the volatility is going to go away. The Fed's coming back into play. There's a lot of uncertainty. And when there's uncertainty, there's volatility. And I think we remain buyers of dips and just be patient. Not every month the market is going to go up. I know that's a surprise. Not every month the market's going to go up.
I want to finish on that with you, Ashok. The equity market, the NASDAQ down 0.9, the S&P up a little more than 0.1%. Ashok, this has felt so tough. And I read the headlines over the weekend. I was reading around, and a lot of them were forecasts. And I often say, by definition, a forecast can't be wrong. It's a forecast. But when I see these gloomy forecasts with the ISM at 69, the labour market looking pretty decent, what do you say back to that, Ashok, when you speak to clients and they're getting doom and gloom and all of that in their outlook, yet we have an ISM at 69?
We say, keep in mind, the fundamentals and the global growth dynamics for the next 12 to 24 months at a minimum are still quite strong. And there is certainly the potential that the Fed and the ECB can mess this up and hike too much. But there's also an outcome where, we muddle along and we end up with high growth, Fed inflation comes off, and we continue in a low rate environment. And that's going to be good for a lot of financial assets. And lastly, we talk about China. So far, China, they're engaged in a restructuring of their growth. They're easing. So far, they've maintained and been able to contain this sell-off to the property markets. But if China can navigate this scenario, that could be something that ends up being more bullish than bearish.
I've enjoyed this morning, guys. We're going to talk about China in just a moment. I just want to say thanks to all three of you. Ashok Bhatia, Michael Purvis, Victoria Green, thank you very much. Coming up on the programme, we turn to China. Investors debating the market implications of a slower growing China.
It will be unlikely that you would see interest rate rise in China while you're going through this restructuring within the property sector and the large deflationary impact that can have within the economy.
The PBOC getting to work, a rate cut. That conversation next. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The antibody responses produced by this vaccination is able to potently neutralize the virus and a number of variants of concern. A lot of the vaccines being developed currently require super cold storage. One of the great advantages of our patch is that we're able to remove the cold chain. We've been able to stabilize the vaccine on the patch for at least a month at room temperature and a week at 40 degrees. So this makes logistically vaccine rollout a much simpler proposition, removing the cold chain from transport.
I think there are bigger challenges more broadly in China in terms of zero COVID policy, curtailing growth, and having that impact on supply chains.
Well, as Peter Fitzgerald of Aviva Investors worried about China's COVID policy curtailing growth, even as the People's Bank of China cuts the reserve requirement ratio to counter the economic slowdown. The bank writing in a statement the following: the aim of the RRR cut is to strengthen cross-cyclical adjustment, enhance the capital structure of financial institutions, raise financial services capabilities to better support the real economy. A lot of central banks speak there, Damien Sassin of Bloomberg Intelligence. Let's start right here. I've always seen this as easing the supply of credit, not adjusting the price of credit. Is this the kind of support we need?
All right. Of course, it has nothing to do with the property sector, Jonathan, nor does it have anything to do with dollar yuan, which is basically trading near an all-time high and very close to those levels, as we mentioned earlier, where we saw the shock devaluation of 2015. But yes, all focus is on Evergrande, 83 million in coupon payments. The grace period expires today. Kaisa on Friday, another 88 million in coupon payments. Grace period expiring then. And so look, you know, I mean, we've got some pain in the property sector, but imagine if we can get through those two restructurings where we actually have a technical default and bondholders and creditors are actually talking to the company. Well, then we might see things turn for the better. And I think, you know, the PBOC cut 50 bips. There's more to come. I mean, I think we're going to probably see 50 to 100 bips in the new year as well.
China's credit market speaks for itself. High yield debt, spreads, yields aggressively high, distress levels. We've talked about it for months now, Damien. If you told me all these things, if you told me the dollar index on the year was up 7 percentage points and then asked me to guess where the Chinese currency was, I probably would not have said it's stronger year to date against the US dollar. For me, Damien, the mystery of foreign exchange, what dollar China's doing down here at 637.69. How do you explain that?
It's the euro. It's euro dollar. I mean, in my opinion, it's that euro weakness that's really weighing on me. If you just look at cross-currency basis swap spreads, I mean, that is where the market's got to be focused. Through this year-end turn, there's a shortage of collateral of French and German T-bills because the ECB bond buying program has crowded everybody out. And so you see the euro depreciating. Certainly, if you look at the CFETS basket, it's really, I mean, it's what's driving up that basket. It's up 8.5% year-to-date versus that 2.8% gain in dollar yuan. That differential is what's causing a lot of the angst that I think we're seeing in markets.
And that's the major weighting in the dollar index. Explaining some of the move we've seen year to date. Damien, thank you, sir. As always, Damien Sassower. The view from Kit Juice's SocGen. Euro dollar likely to trade below 110 in the first half. But here's the key part. A move to 105 or below probably needs a significant rally in dollar China, which is a risk rather than a likely event in 22. Just linking up what Damien's talking about with what Kit's talking about in G10. Want to turn to the equity market and everything related to China. Taylor Riggs getting in early for us. Thank you, Taylor. What a move it's been for these tech stocks out of China.
It's unbelievable. When you talk about angst in the market, there's probably no better way to look at it than the Hang Seng Index. You're now off about 15% in just the last few weeks alone. I was taking a look earlier. You're only up 3 in the last 15 sessions for shares of what, like Alibaba and Didi. How much of this, as Damien was really talking about, is that macro conversation, a big crackdown on big tech, and then in part U.S. saying, you know what, we need transparency if we're going to have some of these big tech companies, some of these big IPOs in the U.S. So that is where you get sort of that conversation about Didi planning to delist from the NYSE, maybe relist in Hong Kong. The micro conversation, if you want to talk a little bit about some of that slowing e-commerce growth, has been a new CEO in charge of Alibaba. All of those, as you can see there, putting pressure on some of those individual stocks in the last month as well. Finally, if you take a look at the terminal, though, John, what it means as well, I don't know. Is this the attractive entry point? We're taking a look at the forward PE ratios on the Hang Seng Tech Index. You're now actually basically back at parity to the MSCI World Tech Index. On a forward PE ratio, you're still at about 28 times, but it is that white line of the Chinese tech that has really, really come down as you think about, is China tech uninvestable?
We've been talking about this now for a number of months. I think the new piece of this, after years of talking about the US having a conversation about pushing these names off the exchange, Damien Sassower, the new piece of this is the pull. The Chinese Communist Party is making this decision for some of these companies. They want these companies home, don't they?
Yeah, they absolutely do. I mean, look, this is really about, and Taylor and I were just talking about this offline, this is about Chinese companies, management teams unable to adhere to financial standards, to auditing standards. And so here in the U.S., they're uninvestable. The VIE, the variable interest entity structure, is uninvestable if you ask just about any investor. So they're going to all be moving back to Hong Kong. And then it's anyone's decision whether or not investors are going to still buy them, given the lack of transparency. My bet is absolutely they will, because investors need growth. And as we go into 2022, Jonathan, this inflation story is definitely going to shift to growth. You want to talk about transient growth.
You're in a part of the company where you can say the U word. We can't do that, Taylor. We have to ask the question as to whether it is uninvestable or not. Taylor Riggs coming up a little bit later at the close. Looking forward to the coverage. Taylor, thank you. To Damien Sassower of Bloomberg Intelligence, thank you very much, sir. To break down this equity market on the S&P 500, where are we 20 minutes in on the S&P? Up about 0.5–0.6% with your sector price action. Here's Greg Gupta.
Well, good morning, John. A fairly broad rally when you look at the S&P 500 today, of course, after the sell-off that you saw last week. To the top of the leaderboard, you do, of course, have utilities, industrials, consumer staples, and energy somewhere falling in the park. A lot of those yield-sensitive sectors really at the top of the leaderboard. Towards the bottom, though, you have consumer discretionary and information technology. A lot of that has to do with EV makers in particular. The SEC now opening an investigation into Tesla over whistleblower claims on solar panel defects, according to Reuters. That, of course, weighing on consumer discretionary stocks. And with those consumer discretionary, you also have semis lagging as well. That's the IT index you do see at the bottom of that leaderboard. And with it, John, it really comes to fruition here in October, in November. That EV boom was all the talk. It seems in December, it's losing some of that steam.
Kriti Gupta with the latest sector price action. Kriti, thank you. A brief mention of the financials there. I want to pick out a single name. It's Wells Fargo, up a little more than 3 percentage points. We mentioned the call from Morgan Stanley early this morning from Betsy Gracie, raising the likes of Goldman and Wells Fargo. Here's the call. Upgraded to equal weight from underweight. That's Goldman. Wells Fargo raised to overweight from equal weight. Here's what underpins this call from Betsy Gracie. On the variant, she says, at worst from an economic perspective only, we think this drives 1 quarter of slower growth with no lockdowns in the United States. But it's a call on rates as well. We're now adding an incremental 3 rate hikes to our estimates, partially offset by higher expenses, which drives up 23 EPS, a median 3%, with Wells up 10%, the most rate sensitive. Bit of a rates call there from Betsy Gracie and Morgan Stanley on what it means for the financials. A big lift for the likes of Wells Fargo. As I say, raised to overweight from equal weight. Their stock is up by more than 3%. Goldman upgraded to equal weight from underweight at Morgan Stanley. More still to come on this market. Coming up, the market moving events you need to be watching. That'll be next in our trading diary as we enter the final straight into year-end 2021 and look ahead to 2022. It's crystal ball season for financial markets worldwide, where you stare into a crystal ball and try and work out what's going to happen next year. Before we close out this year, CPI on Friday, going into next week, 48 hours, absolutely stacked with central bank decisions. The Fed deciding on the Wednesday, December 15th, and then on the 16th, the ECB and the Bank of England. We'll bring you the trading diary next. From New York, this is Bloomberg.
Talking about Bloomberg surveillance.
There's some guy out on Twitter who says I look like I'm on.
I know, I noticed that.
Do you think I need a lift? Is it time?
What did he say about me? What did that particular gentleman say about? Let's have a look. One of them is near 101 years of age.
Which one would that be?
The other has an ego in the orbit of Mars. Who's that?
I have no idea.
Mrs. Lisa, the only chance to productive conversation. It's a fairly accurate summary of this show, isn't it, Tom?
The eyes, or should I do the whole thing?
9 a.m. in Beijing and Shanghai.
Good morning, everyone.
Have a great evening.
So recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
25 minutes into the session from New York City this morning. Good morning. Here's the good news. For anyone sick of Fed speak, it's the quiet period, the blackout period. No Fed speak whatsoever until that central bank decision next Wednesday. Not this Wednesday, next Wednesday, December 15th. Going into that, here's the bad news. If you're long the NASDAQ, it's still pretty choppy out there. The NASDAQ 100 down 63, negative 0.4%. It's a bounce back on the S&P from a week of losses. The S&P 500 up about 0.4%. That's the equity picture. Here's the bond market story. 2s, 10s and 30s. For all the talk of rate hikes and a faster taper, an aggressive tightening maybe, or a more aggressive tightening relative to what you might be expecting, your 2-year yield, the front end of the curve, still below the intraday high of the year so far, which is 65 basis points. We had another look at it on Friday's session. This morning, still short of it, 61 basis points, even with yields up another couple of basis points on 2s. On 10s up 4, we're looking at a steeper curve. Finish on the yield curve on the year so far. The curve's a bit steeper on the year, but it's been a round trip on the year so far. Right now at 76, closing out the year last year at 79 and peaking in Q1 at 157. That's the price action. Let's get you the trading diary. The president speaking at 2 p.m. Eastern time. A ton of central bank decisions through the week. Brazil, India, Canada. Claims on Thursday. University of Michigan Consumer Sentiment Survey on Friday. And we round out the week on Friday with a big one. It's CPI in America. From New York City, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
An extra $1 trillion in spending not increase inflation?
By increasing the productive capacity of this country. And that's a very important thing that we, frankly, have not successfully done across most of my lifetime. You know, I've been waiting for this legislation for months since I became Transportation Secretary, but various presidents have been hoping to reach this day for decades, and it hasn't happened for all kinds of reasons. The American public has been rightly impatient. Now we're getting it done, both making up for lost time and laying a better foundation for the future. Let me also point out to the fact that Part 2 of the president's agenda, what I like to call the big deal, but Part 2 of that, the Build Back Better Act, has even more that will help beat back inflation by lowering some of the costs that Americans feel most acutely, the cost of childcare, the cost of healthcare, the cost of housing, the cost of prescription drugs, bringing those down while also making sure that we ease some of those labor market issues we have by making it easier for working parents to afford to go back to work.
Do you ever commune with Conrad Hilton? Do you ever get any messages from heaven from him saying you're doing a good job protecting my name?
I haven't, but I did meet his son, Barron. He was quite proud of what we had done with the company and suggested to me Conrad would have been as well.
On the supply chain, are you starting to see things improve? And if you are, where specifically, sir?
Well, this year we have been mostly affected by the semiconductor situation. And we believe that the Q3 was the quarter that was most affected.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by surprise. Their job here was to survey and report back to their superiors, and did not come with medical aid of any kind.
People think that FEMA is there to hand out bottles of water, and it's not what they do. FEMA has a role to play. They have a very specific role. They bring in ships, they bring in airplanes, they bring in tractor trailers with pallets of things. But they're a big machine, and there's gaps in that thing. And you're seeing one of the gaps here, and we help fill that role. These guys are in a bad situation before, and now they're struggling for real basic things. One of the risks that you run is people going from fear to hopelessness. Those are the folks that we're trying to reach.
And how are they reached? How are they even found?
Word of mouth, mostly.
And what's your role in all of this?
Ghost in the machine. I'm lucky enough to be able to communicate with folks in FEMA, the state of Puerto Rico.
For a ghost, Robert makes his presence well known. Not only was he the de facto leader of the mission, now with FEMA in tow, he created his own maps to survey storm damage.
So we're right here.
And delivered them to FEMA HQ free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
Our next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá tan solo? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
In the end, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.
When I met him first online, I found him to be really sweet. I think I was the one who was talking for an hour. He was just listening.
When we met, I saw her. She was beautiful, intelligent, and kind, which was, something that I was looking for.
Anshu and Sumit are one of about 12 million couples that get married in India every year. Unlike their parents' generation, they're not from two close villages, but from two cities on opposite sides of the country. And their love didn't start through community matchmaking, marriage brokers, or classified ads in newspapers, but began online.
So we met through jeevansati.com. So it's basically an online portal where we have detailed profile of different grooms and brides.
It makes a lot of remote profiles who are located in distant areas more accessible.
Thanks to growing internet and smartphone usage, matrimony websites and apps in India are starting to disrupt the matchmaking industry. More and more people are finding their partners at the click of a mouse. jeevansati.com, where Anshu and Sumit met, is one of the biggest players. Young Indians looking for love set up profiles including their caste and horoscope, but their criteria for choosing spouses appears to be changing.
We have seen the shift from, traditional caste community conservative parameters to something like which is more focused on education, employment.
Anshu and Sumit's marriage was initiated by their parents, but modern Indian couples like them have more input than previous generations.
We looked up to them to agree for the proposal, but it was primarily our decision that we wanted to be with each other.
So what's the emoji you use the most to send to each other?
There's a bear, which basically we use for indicating a hug.
Yeah, that's our language basically. Bear icon for a hug.
Time flies when you're in love, and just 1.5 months after they first met online, the couple got engaged. They decided to hold their wedding less than 3 months later. But planning a traditional Hindu wedding on such short notice is no easy task. There are websites and apps for that.
We searched online, we got in touch with Wedding Brigade, and they helped us finalize the venue. And it makes the search faster and efficient.
Startups like the Wedding Brigade are challenging traditional wedding planners in this $50 billion industry. It provides various services from booking banquet venues to buying wedding gowns. The website makes money by charging commission from vendors.
People don't want to be limited to what is available around them. They want to know the entire range of options available before making a decision. And now it's easy to find almost everything on one portal.
Anshu and Sumit are officially married in a ritual that has gone on for thousands of years, but their love started in a very new way. Technologies might be changing the way couples meet, date, and get married in India, but they're definitely not changing everything.
The technology was only the first level help that we could get to find each other. Everything else was like very humanly and emotions and feelings based.
Massachusetts Senator Elizabeth Warren has become a symbol of everything the Republican Party stands against.
Everyone gets a right to basic health care. We need strong oversight of these banks.
A legal scholar and a consumer advocate turned politician, Warren has branded herself as a champion of the working class and made a career out of standing up to big business. While rumors of a 2020 presidency bid remain just that,
I'm not running for president.
Her Senate seat is up for re-election in 2018, and Republicans are already pumping millions into super PACs to defeat her. This is the story of how a law professor and politician came to be seen as the biggest threat to Republican values and the greatest hope for progressive America. Elizabeth Warren was born Elizabeth Ann Herron, the youngest of 3 siblings, on June 22, 1949 in Oklahoma City to middle-class parents. After waiting tables to help her family pay the bills, Warren became a star on the high school debate team. She landed a scholarship to George Washington University at the age of 16, but 2 years later dropped out to marry her high school sweetheart, Jim Warren. By 1980, Warren was a mother of 2, divorced and remarried, had earned lecturing and publishing highly cited work on bankruptcy and commercial law at 7 universities around the country, eventually settling at Harvard Law School. But Warren wasn't always a liberal lion.
Elizabeth Warren used to be a Republican, actually.
That's Stephen Dennis.
I'm a Senate reporter for Bloomberg. Around the time that Elizabeth Warren switched parties, she became a fierce opponent of a Republican drive to make it much harder to file for bankruptcy. She fought that for a decade. It ended up passing anyways.
While her efforts ultimately failed, her warning calls were heard in 2008.
We're in the midst of a serious financial crisis. Our entire economy is in danger, and without immediate action by Congress, America could slip into a financial panic, and a distressing scenario would unfold.
Professor Warren was tapped to help with oversight in the government bailout.
She would excoriate bankers and their bonuses and their practices.
Why should the U.S. taxpayer alone carry city?
She proposed a series of tough regulations, which became the basis for much of the Dodd-Frank financial law that we have today. That sort of catapulted her to national stardom, particularly among the progressive left.
Encouraged by her newfound notoriety, Warren declared her bid for the U.S. Senate on September 14, 2011. During the race, her opponent Scott Brown tried to derail Warren by accusing her of falsely claiming Native American heritage, a controversy that earned her the nickname Pocahontas. Nevertheless, she was victorious and won the Senate seat by a comfortable margin. She used her new tenure to challenge everyone, from banking regulators and Treasury officials to members of Wall Street and Congress.
I'm really concerned that too big to fail has become too big for trial. We need tough new laws to hold corporate executives personally accountable. No one should be above the law.
She called for Wells Fargo CEO John Stump to resign for fraud, introduced the Bank on Student Loans Fairness Act, and reintroduced the 21st Century Glass-Steagall Act. In 2016, after staying silent during the Democratic primary battle, Warren finally endorsed Hillary Clinton and had some harsh words for candidate Trump.
Donald Trump is a loud, nasty, thin-skinned fraud who has never risked anything for anyone, and that is just one of the many reasons he will never be president of the United States.
But she was wrong.
The forgotten men and women of our country will be forgotten no longer.
Warren wasted no time resisting Trump's agenda.
Have you ever managed or overseen a $1 trillion loan program?
I have not.
How about a $1 billion loan program?
I have not.
Okay.
In the Donald Trump era, Elizabeth Warren has been playing defense and trying to prevent Donald Trump and his cabinet appointees from rolling back protections that she helped enact.
Warren actually found herself rebuked by Mitch McConnell for reading a letter by Coretta Scott King about Jeff Sessions' record on racism during his confirmation.
She was warned. She was given an explanation. Nevertheless, she persisted.
That moment became something that's on T-shirts, bumper stickers, slogans, and that really galvanized a lot of support for her. It's been very hard for Republicans to get much of anything done this year, and that's at least in part to this resistance movement that Elizabeth Warren has helped champion.
We are here to fight back.
Enough of Elizabeth Warren. Like you, millions of dollars are being funneled to defeat Warren in the midterm elections in 2018. But it's the rumors of a 2020 presidential bid that has further prompted powerful donors to fund her opposition, often using the same playbook of constant and ruthless ad campaigns that many believe helped Trump win in 2016. It's anyone's guess if she will endure what Hillary could not.
You know, the question for Elizabeth Warren is whether she can go from being a liberal firebrand to somebody who can regularly get 60 votes for initiatives in the Senate and 218 in the House and drive an agenda, and whether she can bring together coalitions for political victories. That's the challenge, and we'll see what happens.
Okay, traders, it's time to place stop for our Bitcoin. We're already in profit, around 1%. So I'm going to place a stop for Bitcoin at 48,641. It will give us 0.5% in profit. In our case, it will give us 500 pounds in profit. Okay? So all of you guys who started trading with me, please place stop for your position at 48,000. We're still in a holding position. It's just to make sure if the price will move lower, we will secure our profit and will not lose any money. Okay? Okay, guys, well done. It's good trade, and I'll speak to you later.
Sadiq Khan, the mayor of London, has made some powerful opponents.
He doesn't know me, never met me, doesn't know what I'm all about. I think they're very rude statements, and frankly, tell him I will remember those statements.
My message to Donald Trump and his team is that, your views of Islam are ignorant.
He's the first Muslim mayor of a major Western capital and proud of it. This is how Sadiq Khan went from the son of Pakistani immigrants to a lawyer, lawmaker, and now the mayor of London. Khan's parents emigrated from Pakistan. His father was a bus driver, his mother a stay-at-home seamstress. The 10-strong Khan family squeezed into a 3-bedroom flat in South London. He wanted to be a dentist, but TV in the 1980s convinced him otherwise.
Objection!
LA law with its swagger and ill-fitting suits caught Khan's eye. He graduated in 1991 with a degree in law from North London University and joined a human rights firm. Khan worked a number of high-profile cases, often clashing with London's Metropolitan Police Force. But he had bigger political ambitions.
This is what being a new MP is like, squatting on a bench in the absence of an office, dealing with letters from constituents.
Reports are just coming in of an explosion here in London.
So there's just explosions, and then it was just smoke everywhere.
Everyone's just asking what's happened.
Only 2 months after Khan entered the Commons as a Member of Parliament, London was attacked by Islamist extremists.
That day will stay with me for the rest of my life.
He spoke out against the attacks both as a London MP and as a Muslim.
He has been very clear about his opposition to violence, opposition to terrorism, and has set out to make the case for a more open and peaceful Islam.
That's Thomas Penny, one of Bloomberg's Westminster correspondents.
Here is a man who is a Muslim, and he is standing up and being open and straightforward and being clear that the problem here is not Islam, but it's Islamic extremism.
In 2015, a decade after the attacks, Khan ran for mayor of London, and his faith was back in the headlines. His opponent, Zach Goldsmith, trying to link Khan to radical Islam.
The debate got again personal and nasty. The Goldsmith camp has called Khan extreme and accused him of associating with, quote, those who seek to do our police and capital harm.
It's a pattern of behaviour.
Even the former Prime Minister David Cameron repeated the allegations.
He shared a platform with Sajil Shahid, the man who trained the ringleader of the 7/7 attacks and accused the United States of bringing 9/11 on themselves.
But the smears didn't stick.
Zach Goldsmith ran a very negative campaign that was based on what people...
Okay, guys, as you can see, position closed. We closed position and it moved straight away up. But we're still in profit. Well done, guys. If you close position at this level, in our case, we have £500 in profit. In your case, depends how much you decided to invest. This is the profit. Broker probably already sent you confirmation. Okay, stay safe, and we still have several positions open that you can control, you can see, and you can follow them. And I'll speak to you later as soon as new opportunity will arise on your screen for new trades. Okay, stay safe, guys.
And the police were saying how much they welcomed this because they knew where they stood, and it was more straightforward to work with. So he works like a lawyer, he works like a government minister.
Khan's kept his faith at the fore. He's an outspoken voice for moderate Muslims across the world.
Donald J. Trump is calling for a total and complete shutdown of Muslims entering the United States.
Now, by giving the impression that Islam and the West are incompatible, you're playing into the hands of the extremists.
The ongoing spat between Khan and US President Donald Trump escalated when Trump went after Khan, misquoting him on Twitter just hours after the terrorist attacks of June 3rd, 2017. Khan's now one of the most prominent Labour politicians in the UK. In fact, a recent poll of Londoners found Khan was more trusted to keep the country safe from terrorism than the Prime Minister or the Labour leader. His story of going from the son of an immigrant bus driver to the mayor of one of the greatest cities in the world plays well with Londoners. But can he appeal to the rest of the nation? Has Khan got his eye on the top job? And is the UK ready for a Muslim Prime Minister?
What does it take to change the world? A big army? A cure to a pandemic? A revolution? All of these take either a lot of people, thousands of hours, or massive amounts of space. But for Julian Assange, all he needs is one room, an internet connection, and the world will listen. Assange is located here, and more specifically, right here. And from that location, he's posted government secrets, classified documents, and leaked emails from some of the world's most powerful people. And in doing so, has been labeled a hero, a villain, a nihilist, and everything in between. This is how an Australian programmer sequestered in the Ecuadorian embassy in London became one of the most influential and notorious people in the world. Born in 1971 in Townsville, Australia, Assange has always been on the move. Living in over 30 homes by the time he was in his mid-teens, Assange, along with his mother and half-brother, finally settled down in Melbourne. His introduction to hacking started at 16 when he was given a Commodore 64, which he attached to a modem. He attended the University of Melbourne, where he studied programming, physics, and mathematics. He never graduated, but that doesn't mean he didn't get an education. By 1991, Assange hacked into the Pentagon, U.S. Navy, and other branches of the U.S. government. In 1996, he was caught by the Australian Federal Police and charged with over 30 counts of hacking and computer-related crimes. He didn't get any jail time, but he was fined $2,100.
I think the first taste of what would come later was the hacking that he did as a young programmer, and that really sort of foreshadowed a healthy skepticism of the use and abuse of technology by governments.
That's Vernon Silver.
I'm a reporter for Bloomberg's investigations team.
Assange's youth as a hacker laid the foundation for him to start WikiLeaks in 2006. But what is WikiLeaks? It's a website that posts unfiltered, usually classified documents. What separates it from every other media outlet is that they have no editorial hierarchy. With a publication like the New York Times, information comes in, they take that information, package it, then disseminate it for the public to see. WikiLeaks, however, cuts out the middleman.
WikiLeaks gathers information, most of it given to them anonymously. So what they're doing is really very simple. They get the information in one end from who gives it to them and out the other with sometimes minimal interference. Julian Assange is the leader of that, the mastermind, the creator, and really, because he thinks of it as a journalistic enterprise, the editor-in-chief.
But every story starts with a source, and Assange has some unconventional sources.
Julian Assange does not hack as far as we know. He is the recipient of people who are either insiders who give him secret documents or hacked emails from a foreign power.
That's Eli Lake.
I am a columnist for Bloomberg.
And there was no source bigger for Assange than Chelsea Manning. He used to be known as U.S. soldier Bradley Manning. In 2010, Manning provided Assange and WikiLeaks with hundreds of thousands of leaked government documents. WikiLeaks quietly began releasing the documents in February of 2010, then made big headlines in April by posting what is now known as the collateral murder video.
Come on, fire!
It was a vivid, graphic video. It changed the debate on the Iraq War, and importantly, it put WikiLeaks on the map when they put it online, and they couldn't be ignored at that point.
And those leaks were just the beginning. They went on to post more than 90,000 leaked documents known as the Afghan war logs, 390,000 documents known as the Iraq war logs, and 250,000 private messages between diplomats called cables in what is now known as Cablegate. These leaks were met with very real ethical questions.
The problem with publishing those cables was that a number of confidential sources for U.S. diplomats who faced real danger when their names were exposed.
Then Secretary of State Hillary Clinton drove the point home that
every country, including the United States, must be able to have candid conversations about the people and nations with whom they deal.
Shortly after Cablegate, the Swedish government issued an arrest warrant for Assange on allegations of rape and molestation. He claimed the allegations were fabricated to get him extradited to the United States, a claim the U.S. government denied. Either way, Assange's next move was
to seek refuge in the Ecuadorian embassy, which really was the beginning of the new chapter in his life and what we're dealing with now, which is him being stuck in London.
What was supposed to be an office in an embassy is now Assange's self-imposed prison to this very day. But that doesn't mean he's slowed down. Since being trapped in the embassy, WikiLeaks has released files about Guantanamo Bay prisoners, Syrian political figures, and the draft to the Trans-Pacific Partnership. And then came the 2016 U.S. election.
Thousands of leaked emails showed Democratic Party officials possibly plotting against Bernie Sanders in his race against Hillary Clinton.
Over the course of 68 days, WikiLeaks released 20,000 confidential Democratic National Committee emails. In terms of the presidential race, if you look right here, when Assange released the first batch of emails, Trump actually takes his first lead against Clinton.
I think we've had enough of the Clintons, in all fairness. Don't you think?
Once WikiLeaks started